My fellow investors, welcome back to the Newcomer Investor Channel, where we uncover the story behind great businesses and make investing fun and accessible for everyone. Today, I am very excited to introduce Asheef Lalani, who I was able to meet in person, actually. He is a very, very experienced and accomplished investor and a Fairfax professional. He knows everything about the company. And we decided it would be great to have a discussion. So, like I said, we actually met in person. It's actually, you're the first of all the people in the community that I actually met. It's great
Oh,
because we
wow.
both live in Toronto and we had such a nice discussion. And as we were talking, I was like, oh my God, this should have been the podcast. So you so graciously agreed to come on the show and for us to have a discussion again. It's going to be an even better one. But yeah, welcome. How are you doing?
I'm good. I'm good. Thanks for inviting me, Anthony. It's a real honor to be on your podcast. I found out about it just a few months ago. I think the first time you posted about Fairfax, and I search on Twitter for everything Fairfax. And if you do want to follow me on Twitter, I should give you my handle. It's at Brown Marubozu. It's confusing, but it's Brown Brown Marubozu. There's a story behind it, but it's not that interesting. It's really just funny for me. So I'll leave it at that. But yeah, it's really excellent to be here and to join you. And as you know, I love talking about Fairfax, so I'm excited to be here.
Hell yeah. All right. So let's get started. This is something I like to do with all the guests is before we dive into the company itself, I want to hear a little bit about you. Like who are you, your background, career history, all that kind of stuff.
Yeah, sure. I was born in Toronto, actually. I live less than a mile from where I was born, so in that sense, I follow that stereotype. But I went to school at the University of Waterloo. I studied math and accounting, and went on to get a CA, and worked at PwC, an article there. But as soon as I qualified, which is in June of 2002, I moved to UBS. I was lucky enough to get a position in equity research, and I covered software and media stocks. And I did that for about a year and a half. And after that, I went to the sales desk for about 6 months, equity sales, where so it was a combination of a desk analyst and risk arb analyst and risk arb sales. So I was speaking to clients and trying to walk them through transactions or other event driven situations or long short trades that we were recommending as a firm. I only did that for 6 months. After that, I was asked if I was actually given a choice whether I wanted to join the prop desk or to become the analyst on Nortel.
Oh wow.
And it was a difficult decision because becoming the analyst on Nortel had a lot of prestige associated with it, but
Mm-hmm.
I didn't care about prestige, and I really just wanted to be closer to the decision making when it became to investments. I didn't know Nortel was going to go to zero at that time, but so it wasn't, I just thought it was daunting. And I thought the prop desk gave me a chance to actually do what I wanted to do, which was to make investment decisions and make money for the firm.
Wow. Okay. What a storied history, huh?
Yeah.
That's
And
a
so,
lot. Yeah.
I should say that I lasted in prop desk till 2012. If you're familiar, in 2012, after the great financial crisis, something called the Volcker Rule was introduced, where which effectively made my job illegal in the U.S. at least, where
Oh.
we couldn't invest on behalf of on the bank's balance sheet. We weren't allowed to invest anymore or speculate. And so at that point, I was either said you could switch to a different role or and do something else in the bank, or we'll give you some money to go away. And I took the money. So
Huh.
I left. I left the bank, and since then I've been managing my own capital. I call the firm Bursey Park Capital, but it's really just me. It's a single family office, and that's what I've been doing for the past 12 years. So I still lean on heavily on my UBS credibility, but
Mm.
I've been on my own longer than I was there, and so that's been the journey, I guess, up until now. And
Wow.
yeah.
Uh-huh. But your research speaks for itself. Yeah, I know
Oh,
you're
thank you.
leaning on the UBS, but everything that you post, and for our listeners, like you put your Twitter out there, and I'll be
Hmm.
putting it in description too.
Excellent.
Definitely follow him on Twitter because so much good research, and people will see that from this discussion. Okay, let's segue into your investing style now. So you've been managing your capital for the last 12 years. How,
Hmm.
yeah, what's your style?
Well, I think even back at UBS, we were always very value driven in terms of how we looked at things. So, I think different types of investors use different things to determine the potential outcomes or to assess the probabilities. And so our approach at the bank was to use our experience and to use intrinsic value to try to come up with probabilities of various outcomes, and that would let us measure what I call expected value or the expected intrinsic value. So accounting that there's no certain way that the world will turn out, and taking that into account and using that in our probability analysis for the various outcomes. So I call what I do expected value investing.
Hmm.
I don't know anyone else who calls it that, but I think there are a lot of people who are there. Not a lot. There's a few of us who are still like probabilistic investors, and I think if you think about how other people invest, I think it's important to look at the distinction. I think everyone is sort of trying to determine the probabilities of various outcomes, but they use different methods to do it. So if you're a quality investor, you're using certain heuristics to determine
Hmm.
the potential outcomes. And if you're a technical investor or a trader, you're using price to determine the probability of various outcomes, and which is why it's so important for them to have really strong stop losses and so on. Whereas for an investor that's value focused, when something goes down, it becomes more interesting. Whereas if you're a trader and something goes down, it's like, well, you have to sell because it hit your stop loss because you don't really have a good idea of what it's worth.
Yeah.
So that there's these different approaches, I think, to investing, and they're all legitimate. I definitely don't say that there's anything wrong with doing whatever you do that makes you money. I think ultimately, I think it comes down to people's personalities and sort of where they're what they're really good at. And some people are really good at following rules, and that helps them get there. And I'm probably too good at breaking them, and that can get me into trouble sometimes. But ultimately, I think value driven expected value is what I describe it as.
Love it. Well, I can relate a lot in that. Well, I relate with the value part. The my mathematical skills are not not as good as yours, but other than that, I very much as I also respect all schools of thought. I very much like value investing and contrarian investing as well, which is why I love Fairfax so much. Let's take this time now, I guess, to switch a little bit into, and you touched a little bit on it, but market structures and how they've been changing over time. I know this is something that
Yeah.
you've spoken about. We spoke about too when we met actually, right? And that actually blew my mind, a lot of what you were saying. So I would love our listeners to hear your take on that evolution over time.
Sure, sure. So I would say when I joined the desk, over 20 years ago, when I joined UBS in 2002, I had a chance to speak to a lot of long short funds and other investors, and so I had a good feel for what people were looking for and how they would make decisions. And back then there were a lot more investors who were probabilistic investors like myself, a lot more investors who were focused on mean reversion, and trying to take advantage of opportunities where something was trading too cheap versus relative to something else in the sector, and the trades would be put on long short to try to take advantage of that, or investors would switch from one name to another name. They were long only in order to take advantage of that, and because of that, whoever was there first ended up making the best return. And I think David Einhorn was on Masters in Business earlier this year, and he talked about that philosophy of how they invested, where they would look for something that was trading at a discounted multiple, where earnings were going to grow perhaps more than the market expected, and they could take advantage of not only the multiple expansion but the earnings growth and earn a very nice return in a relatively short period of time, and then they would move on to the next name. And I think the that kind of world existed until the great financial crisis. The GFC really highlighted that there were lots of ways to lose money that people didn't expect they would lose money during the GFC. And that really changed behavior of retail investors, institutional investors, and on top of that, at the same time that was happening, you had quants become much more popularized. The computing power stepped up significantly, and at the same time, passive was taking a lot of market share because effectively, people looked at what they were doing and they said, well, there's a certain types of investments I'm never going to do again because I lost so much money during the GFC. And some examples of that you could probably guess most of them, but some examples would be uh, I'm not going to invest in small caps anymore. I'm not going to
Mm-hmm.
invest in stocks that aren't liquid anymore because I'm not able to sell when I want to because the market's when the market I think is going to go down. I They're going to avoid anything with a lot of debt on the balance sheet. They're going to avoid anything that's too cyclical. So any resource stocks, any price takers, commodity companies were excluded. And it's not hard to see in Canada. Canada's a good example because we have such a large resource market. If you look at the Canadian funds who launched post GFC, who said we're not ever investing in resource stocks, for
Mm-hmm.
example, and we're going to focus on quality. They've had the best performance, right? And so when you think about what quants do is they codify a lot of these things into their algorithms, and so you have all of these funds all using the same data, unsurprisingly, all coming to the same conclusions. And I think after 15 years of this happening, you have sort of the best companies trading at the highest multiples, and everything else kind of left on the side because if you're an active investor, especially if you're an active institutional investor and an asset gatherer, let's say like the big bank funds, it's more important that you keep up with the market than beat the market. It's more
Mm-hmm.
important that you have very low variability versus the benchmark because it's harder for your clients to take the assets away from you. And so it's again unsurprising that this is the direction that the world went. It just took me, a really long time to understand that's what was happening. And I would say it's over the past few years that I started to realize, oh, this kind of this kind of explains what's happening. I call it the everything everywhere all at once theory. It kind of all makes sense when you put this lens on it. At least for me, and I understand that not everyone thinks about it that way. But I think the evidence is pretty clear. Again, my evidence is all anecdotal. I don't have a lot of empirical data. I'm a practitioner. I'm not spending time on researching the effects of this. I'd love for someone to do that. But I think effectively you can see it in the markets, and you can look at examples. You look at a company like Costco, right? It's
That's a great
one of the
example. Mm-hmm.
one of the best companies in the world. I talk about Costco because I think a lot of people focus on the FANG stocks and they attribute the move to technology, but
Yeah,
Costco
it's not just
is
tech. Yeah, it's lots
yeah,
of others.
it's
Mm-hmm.
a retail business and it consistently grows earnings, and so if you once you take off the value factor, for a quant, once as soon as the value factor stops becoming relevant, then it's a shackle that's taken off, and there's no reason to ever sell Costco after you do that because the earnings are always growing, and the earnings variability is very small. The
Yeah.
analyst estimates are all very tightly packed because they've sort of told you the business model, and they hit their numbers fairly consistently. And so that a stock like that will get there'll be no outflows coming, very few quant outflows coming from that. And so you have the combination of the passive demand that keeps feeding the buying, and the quants, keep buying whenever they have new capital coming in. And quite frankly, I don't see anything that makes that change. I think you might have situations where you have a broad-based market sell-off, like during the pandemic, where everything goes on sale, and I think that's one of the opportunities is to buy these really high-quality companies when they go on sale, as opposed to buying them at whatever the prevalent price is, which is what most of the institutional funds do, because it's as soon as they decide to, they never want to overrule the computer, right? Like it's number one
Yep.
rule of
Yeah,
quants
yeah,
is don't
yeah.
overrule the computer. So that to add that extra filter is going to put their performance at risk. So they don't do that. And it's totally understandable, and it works. But effectively, what that means is that the market has changed to investors focused on absolute returns to focused on relative returns. And because of that, the margin of safety or the risk of owning something at a really high valuation is not really a factor that they really think about too much.
Yep. Yep.
And so ultimately, I think that's a good example. And you can see situations where where a specific company has a break in the fundamentals, where something like Meta is my favorite example because in that case, and back in 2022, and I didn't understand what was happening until afterwards, but in 2022, when the stock really was getting destroyed because
Massacred.
they were spending so much on the metaverse, you know, the 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 spending was entirely under their control. And so the minute when they started spending so much in the metaverse, the earnings estimates all got hit, and the quants had to sell. And the clearing price, it ends up coming to a price where investors like me and you, who are active investors, who are focused on absolute returns, will be like, oh, now it's cheap enough for me to buy it. And so
Mm-hmm.
that's how maybe we'll set a bottom in the stock where we matter in those situations. The problem is there's fewer and fewer of us left, because
Yeah.
people who do underperform trying to do it on their own end up handing their money over to an ETF or to a quant, and so the number of investors left to do it, I think, are diminishing. But in that, that is a good example of something where the earnings estimates are cut, they make adjustments entirely under their control, and then earnings estimates start to increase again, and all the money flows back in because it is an amazing business, right? So
Yeah, that is
ultimately,
such a good way that you put this whole thing. And again, like you've worded it again, just as eloquently as when we spoke about it that evening. But I I spent a lot of time thinking about that because, like you said, even though it's anecdotal, we see there are so many examples of that exact trend always happening, and about this thing of like stocks that screen well or don't screen well, and just because of that, you have some amazing companies that are undervalued or whatever, and it takes a really long time for the market to kind of get it, and then when they do, it just goes up to the stratosphere, right? So but yeah, that
yeah,
meta example too is such a good one where the fundamentals were clearly still there. It was still the dominant social media business that prints cash, but
yep.
everyone lost their minds over this metaverse for like 1 year, and now it's hitting all-time highs again, I think, right? It's
It seems like it. Yeah,
insane.
I don't pay attention much to index levels anymore,
Mm,
or the big stocks in the index. It just I found it to be frustrating. And I think once I kind of understood why they traded where they trade, it was less interesting to me. I didn't think I would have any edge on something that is quality, is performing well, and has the multiple that reflects that
yeah.
effectively. So I think the opportunity is in sort of broken or names which have a pause in their earnings growth, and there's a lot of with Meta's case, it wasn't hard to see that it was high quality, but for other names like recently, like Lululemon took a bit of a hit and it's bounced
Hmm.
back. Maybe that's an example. But for me, harder to assess business quality for Lululemon, and the growth, or Starbucks is another example where
Yeah, even
is that
Aritzia. Hmm.
Aritzia had taken a real hit, and I looked at that actually thinking, I should probably buy some on this thesis that quality is going to go back up again, and it worked
I
out.
did, but I
Yeah, you
sold
did it,
too
nice.
early. I
Yeah,
sold too
lovely.
early. I should have let it run more. But
Yeah,
yeah.
well, I mean, that's kind of the point. Like, I think one of the approaches here is when you get a chance to buy something on sale like that, that you just buy it and never sell it, because
Hmm.
until you think earnings estimates are going to go down again, and that's a harder game to play, to think that you're going to have the ability to predict what's going to happen with earnings. But ultimately, as an analyst, I think that's what my job is effectively.
100%. Okay, this is such a great segue now into Fairfax. This is a
Right.
company, obviously, that we are both very passionate about. You've
Mm-hmm.
known this one for a long time, I think, right? And I still remember, when we were exchanging DMs, I think that was right before I was gonna like I'd found it, like someone on Twitter had, and I was looking into it. And then I was like, oh, I should buy it. And then you were like, I was about to go to Portugal, and you were
Mm-hmm.
like, you really should consider this because it's really good. And I was like, ah, you know what? I'll just buy like one share or two shares. And I did. And then when I came back from Portugal, we were up like already quite a bit. And I was like, oh my God. And I looked and I was like, it's still cheap. So I'm just gonna buy more. And I kept buying. So now I got a few, not that many, but a few, right?
Yep.
And yeah, it's still cheap to this day for me. So anyway, I'd love for you to give our listeners, I guess, an introduction of what is Fairfax, what do they
Yeah.
do, and a bit of history.
Yeah. So Fairfax Financial is a property and casualty insurance holding company. And that's a mouthful, but effectively they follow the same business model as Berkshire Hathaway. So they have insurance subsidiaries that provide insurance to mostly commercial clients. They have a small they have some small retail or personal line businesses around the world, including in Canada. But effectively, if you think about what a property and casualty insurance company does, if you've ever bought insurance, and I assume most people have bought some kind of insurance in the past, whether it be like renters insurance, tenant insurance, or home insurance, or car insurance, or and insuring your Ticketmaster, purchase because you don't know if you're going to be able
True.
to make it or whatever it may be. So there's all kinds of things you can insure in the world. But by regulation, any premiums that are paid to an insurance company must be invested in a certain way. For the most part, invested in fixed income securities, bonds, treasuries, etc. And they can invest in a variety of things, but the capital charges are different depending on how risky the asset they're investing in. Right, maybe a little more complicated than we need to get into, but effectively, any earnings that those assets they buy for reserves go to the equity holders. So, and those earnings can then be used to purchase equities as well, and beyond what's needed to be kept in reserves. And so that's effectively what Fairfax's business model is. It started in 1985, started by a gentleman named Prem Watsa, who's one of the greatest Canadians that ever lived. Quite frankly, he'll go down in history. The books will be written, I'm sure, at some point about how much good he's done during his tenure, not just building this company, but all the charity that and good works that he
Yeah.
does.
There are already a couple. I'll
Um,
just cut you quickly.
yeah,
I know you gave me two books that day, which I'm
mm,
very grateful for. So I read the first, the short one. That
yeah,
was such a good book. And it's so packed with so much info in such a small, because it's really short too. Like I read it in
yeah,
like a couple hours or something, but I was like, oh my God, I learned so much. And this guy is so cool. I want him to be my friend, like Prem. He's awesome. And now I'm going through the second book, which is much longer, which is his first 25 years of letters,
right,
and he is so consistent. You read the 1985 letter and then the 2023 letter, and it's like this. He thinks the exact same way, which
yeah,
is a great way, right? So anyway, sorry to cut, but he's
yeah.
great. Yeah.
Absolutely, yeah. The short book you're referring to is it's a history of the first 25 years of Fairfax. You learn about how precarious things were at the beginning
Mm-hmm.
when you're starting a new business, and you see a lot of the ups and downs over the years. And it's such a good introduction to the culture.
Yeah.
And hopefully, Anthony, this year you'll join me at the AGM in April.
Hell yeah.
Yeah, and you'll get to see that culture is pervasive throughout the whole company. The employees are some of the best people you'll ever meet. They're kind, they're generous with their time, and they're very dedicated to their businesses. They really do live by the values that Fairfax, publishes, that they live by. And it's an exceptional company. And it's kind of funny because one of the reasons why Fairfax perhaps is undervalued is that it doesn't pass a lot of the ESG screens, which if
Mm.
people are familiar with, environmental,
Oh
social
yes.
governance rules that
Yep.
that that are used to determine what investments are made. I'm perhaps cynical, but when I look at those ESG rules, they're effectively how they've been applied by the industry again as a marketing tool, is that they effectively are screens for quants. They're trying to screen for
Yes.
quality companies, and that's
100%.
where the performance is. And so it's just another source of buying for the best companies. And Fairfax, because it has a controlling shareholder in Prem, some ESG funds won't consider it. I spoke to a salesperson at an equity desk in Canada who has clients who are in pension funds, and they said they had to get special clearance to buy Fairfax because
Wow.
Allied World provided some insurance for a coal related company, and so
Yeah.
just from that, it becomes on an excluded list. So you can see how, like, names can be undervalued because they're not receiving capital for reasons that really have nothing to do with intrinsic value.
Yep.
There's another filter being put on, and all of this ignores the fact that Fairfax donates a certain percentage of their profits to
Yeah.
communities and causes and charities that are important to its employees.
Yeah.
And
And
so
to quickly jump in, I read
mm,
it's 1 to 2% of pre-tax profits. That's a
yeah,
lot. Like it sounds like not a lot, but you can people listening, ask your company how much of your profits you donate. Guaranteed 90% of people,
yeah.
it's less than 2% of pre-tax profit. Like that's a lot.
It's a lot.
So
It's a lot,
yeah.
and you know, and their motto is, they put out their own ESG report because
Yeah.
I think they're very proud of this track record, and it's called doing good by doing well. So it's the better we do as a company, the more we can donate over time to these causes, so we can grow our impact. And I think that's it. It sort of gives you a insight into the culture, at Fairfax.
Yeah, there's this video too. I think it's by Junior Achievement. I saw it randomly on YouTube, just like
Mm-hmm.
searching Prem Watsa, right? And this video, they induct him in like the Canadian Business Hall of Fame, stuff like that. But it's like maybe 8 minute long video, kind of interviewing him and people around him talking about him and stuff. And yeah, this guy, I want to be his best friend. Like he's great. He's really, really, and you can tell that it's genuine. Like he loves people and he loves investing. Now, speaking of investing, let's talk about his investment style.
Mm-hmm.
What do
Yeah,
you think? How would you describe it?
I think historically he's had a very similar investment style to me, quite frankly. I think it just happened coincidentally. I first bought Fairfax in 2021, so I wasn't patterning myself after him. I was lucky enough. My friend Charlie Fisher, who lives in Seattle, he's telling me about that I should be looking at Fairfax based in Toronto, even though I'm here. But he had spent a lot more time with it, and he pointed out that the value of they're trading so far below book value, and that their investments were trading up so much, but the stock hadn't responded. And that was really the first insight into buying it. But when you look at his investment style, he owns um, a lot of different types of companies that most investors wouldn't buy. And it's I think it's one of the primary reasons it keeps investors away from Fairfax is that they wouldn't own the stuff that's in his portfolio.
Mhm.
So he owns. No, he owns. The largest position in Fairfax is Eurobank, the largest equity position, which is
Mhm.
one of the largest Greek banks. Fairfax owns 34% of the bank. Um, you know, when people hear Greek bank, they
They
sometimes
run
stop.
away. Sorry,
They
I
stop
gotta.
listening.
I
Yeah,
know I'm interviewing you, but I keep
yeah.
jumping in. I'm sorry about that,
No,
but
no,
this
no.
is
I like it.
funny.
I like it. I
As
like to go
I
back and forth.
Okay, so as you
Yeah.
know, right, I grew up in Switzerland. I came here 11 years ago. 11 years ago was just around the time that Greece was almost crashing the entire euro currency. They were a basket case. It was like the worst country ever. Like their economy was in ruins. It was a
Mm-hmm.
complete catastrophe. And anyone who, spoke about Greece, they were like, oh my God, this country is in ruins. So, and that's shortly after that is when Prem decided to start buying into Greek stocks. And so I went back yesterday and a couple days ago. I was just reading all kinds of articles about him. I was trying to find articles about him buying into Greece.
Mm-hmm.
And there's all these Canadian business articles, like National Post, the Financial Post, and they're saying, oh, Prem Watsa's terrible moves in Greece. And it's like from 2014, right? And
Right.
now, of course, Eurobank is firing on all cylinders. Of course, it's recovered. They paid their dividend like 120 million or something this year. First dividend in like years, I think.
Mm-hmm.
And it's an amazing investment. But he had the fortitude to to be contrarian like that in that country that was such a disaster for many years. That takes a special type of person, right?
Absolutely, and I'm not as familiar with the history of all the different investments, but they had an investment similarly in Ireland before that, and so
Mm-hmm.
so they had experience doing this, and they took advantage of this opportunity here. And like you said, now Eurobank's in a much better position, and yet it still trades at only 6 times earnings,
Yep.
despite having a high teens return on tangible book value. And so you have the situation where you have a really cheap stock held within a really cheap stock, and so it's a thing to me that's the most exciting about Fairfax is it has these giant right tails while having a very secure downside. And we should talk about sort of the valuation on a base
Yeah.
on the basis
Let's
of
do that.
yeah, let's because like most value investors that I talk to, and one of the things that I do, like now that I don't work for anyone else, I haven't really changed much about how I invest. I invest the same way, and I talk to as many investors as possible to try to understand why they don't like my stocks. And
Yeah.
because all my stocks are kind of in one way kind of simple ideas, and that they're obviously cheap. And the question is, well, why are they so obviously cheap? Are there good reasons why they're cheap, or not? And so when you talk to all kinds of different types of investors, all the way from retail investor with not that much money to high net worth investors, all the way to the largest pension funds, in Canada, you get an idea of where people are coming from and what's important to them and what's not important to them. And when you talk to value investors, shareholders of Fairfax, most of them are value investors, and value investors who have survived the past 15 years are generally have sort of different heuristics than other investors, and they're very quick to take profits because avoiding drawdowns is super important. And
Uh-huh.
they're
Yeah.
very focused on the left tail, and so they don't want to pay too high a multiple, right? So they'll end up selling too soon in a lot of these cases where it seems like multiple expansion is very likely. And so with Fairfax, when it's analyzed by most investors, they focus on, well, what's book value first. And for a while, Fairfax was trading below book value, and recently,
Crazy. Yeah.
it's gotten up to around 1.2 times adjusted book value, let's call it, because there's some of their assets are marked at a carrying value that is well below the fair value. So there's about a 80 to $100 a share of a discount, that makes the book value look a bit lower than it actually would be in a liquidation scenario. So if you adjust for that, we're still around 1.2 times book value, despite a tremendous performance over the past 4 years.
So
Um,
wait, sorry, I cut you
yep.
here too. So our listeners it's a very diverse group. There are some people that are like you, super experienced, like amazing investors,
Yep.
and then there are others more like me, where we're kind of like beginners or less. So let's
Yeah,
just
sure.
explain for our listeners the difference between mark to market versus carrying value, fair
Sure.
value. So mark to
Sure.
market, right? That is for the smaller holdings, and that is when it gets like the value of it gets adjusted every quarter, right? And then the
Yeah.
second type is is it when they own between 10 and 25%? Is that it?
No,
Equity.
so if Fairfax owns less than 20% of something,
Oh, so then
then
okay.
then it would mark to market.
Oh, okay, yeah. And then
20
20
to
to
50,
50
20 to
is
50 or 20 to 49.9 is equity accounted for.
okay,
So
yeah.
Fairfax will take in its share of the earnings onto its balance sheet every quarter, usually on a lag for some of these public companies like
Right.
Eurobank, because they still have the time to incorporate them in real time, quarter to quarter. So and then anything above 50% is consolidated, which effectively has the same effect as the equity accounting.
Hmm.
And most of Fairfax's equity positions are either equity accounted for or consolidated,
Yeah.
out of the 20 billion of equity investments that they have. So something like Eurobank, where they initially invested and they took some write downs because the fair value went below the carrying value in some cases. And then as the company starts to make earnings, the carrying value starts to go up because they take their share in. And so, but the carrying value can still lag the market value pretty significantly in these cases, because if you get any sort of multiple expansion, you don't get that in the carrying value,
Right.
but you
And
do
so
get that in the market value.
as of their latest earnings, I think they said it's like 900 million or 600 million in total of fair value more than the carrying value,
I
I
think
think,
I
right?
think that might have
Something
been at the end
large.
of last year. I think it's
Oh.
closer to 1.8 billion
Oh,
now, I want to
wow. Okay,
say.
so it's a
Yeah,
lot.
it's a big
Yeah.
number. Yeah,
So
yeah.
this is
Only
so
1.6.
this
It's about 80 to $100 a
That's
share.
insane.
So
So I just
yeah.
want to tie this back again to what you were
Mm-hmm.
talking about at the beginning about the stocks that don't screen properly.
Mm-hmm.
This is the kind of stuff that the quants and the funds and stuff, they don't really see it because that doesn't you only see it if you like study it and take the time to read their 500 pages and then you realize,
Yeah.
"Oh my God, there is value right there that is just not obvious, but it is obvious,
Yeah,
right?"
yeah, absolutely. That's there's a lot of ways in which Fairfax doesn't screen well. So maybe we should talk about that. So not only did we said about the fair value or carrying value, but also Fairfax only reports IFRS earnings. There's no adjusted earnings line,
Right.
and because money management has become a big data exercise, right? The quants are effectively doing a big data exercise where they're analyzing all of the data and then coming to conclusions based on the relationships between the various factors. For Fairfax, because they only report IFRS earnings, the adjusted earnings are used by one or two analysts to represent core earnings. And because adjusted earnings are historically, again, on a big data exercise for all the companies, have the most relevance to stock performance, most of the systems will use adjusted earnings as their base for earnings. And if you look at Fairfax, the forward 12-month earnings based on adjusted earnings looks like about $125 per share. So the stock looks like it's trading around, 10, a little over 10 times earnings, and has a forward ROE of around 12%. But if you look at the forward IFRS estimates, which there are more estimates because that's what the analysts basically just put the estimates as to what the company actually reports. That number is around $155 per share, so significantly
Mm.
higher. Suggests that ROE is 15%. Suggests that it's trading closer to 8 times earnings. And if you're an investor and a quant, quants do this too. If they're looking at the relative valuations, or they're looking at, a business that has a 15% ROE should trade at a much higher multiple than a business that has, a 10% ROE or
Mm-hmm.
11% ROE. So it's another reason why they might not own Fairfax. That again has nothing to do with the actual intrinsic value. It has entirely to do with how the data is reported. You
Yeah,
know.
it's insane how these little like adjustments can make such a big difference in like, oh, we're gonna buy the stock or we're not, right?
Mm-hmm.
Absolutely insane. I quickly want to have a couple of your takes here just on the insurance portfolio in general, like the
Yeah.
performance of the underwriting. I think that's
Mm-hmm.
something that, so again, reading this book, when I see like the 7 lean years that they had where they just lost money every year on their underwriting, and now it seems like it's total opposite, right? What do you think?
Yeah, I mean, I think the interesting thing about Fairfax is that they're super conservative on how they reserve, and so historically, every time they would do an acquisition, right after they did an acquisition, the reserves would really step up, and the combined ratio would go over 100. And just to explain combined ratio
Yeah, for our listeners.
for anyone who's new. So in underwriting, or in the reporting of underwriting profits, the way that insurance companies report it is they report something called the combined ratio, which is kind of the inverse of the margin. So if you have a business that has 100% combined ratio, that means it makes zero profit. And the combined ratio is the sum of the claims that are paid by the insurance company plus the expenses to run the insurance company. Fairfax targets a 95% combined ratio, meaning that they're trying to make a 5% profit. And I ask investors all the time when I start talking about Fairfax, you know, what kind of profit do you think insurance companies make on underwriting?
Mm-hmm.
And most people are like, they think they're getting taken to the cleaners by insurance companies, but for the most part, the margins are actually pretty narrow.
Very thin, yeah.
Yeah, and it's a bit of a commodity business. And one of the benefits that Fairfax has is that they have scale, because they're a top 20 global insurer now, and they can choose when to write business. So it's a capital allocation business ultimately, much like investing is, and they get to decide when they want to write a lot of business and when they don't want to write a lot of business. Um, a big factor in profitability for insurance companies are interest rates, and so we went through a period in the last decade where interest rates were close to zero. And a lot of the insurance company peers would step out in duration and match their claims liabilities, meaning that when you write insurance, you don't know necessarily when the claims are going to come. So you collect the premiums in year one, but you might not have a claim for 4 years, and so
Mm-hmm.
you have to set up your reserves assuming that these claims are going to happen over time. And so most insurance companies will match their liabilities and their assets, because they don't want to take that risk of being offside. Fairfax takes more of a common sense approach, and when they saw that when interest rates were close to zero, they said, yeah, we could stretch from 6-month T bills or 1 year T bills earning 0.5% to earn 1% for if we invest in 5-year bonds, but doesn't seem like it's worth it to do that in case interest rates go up. And so for a long time, they under earned on the insurance business, and it made them look bad on a comparable basis to the peers, and which is one of the reasons why the price to book value just kept going down.
Hmm.
The people were just like, this thing doesn't make money, but they weren't thinking about why it wasn't making as much money as they hoped.
They were taking the long game, basically playing the long game.
Playing the long game, which they
Yeah.
always do, yeah. Which is really like, it's a really big advantage over other institutional investors to be able to play the long game because, I think, institutional investors have a lot of constraints on them that aren't all their fault. Their clients put these constraints on them to
Yeah.
try
They
to
don't want
protect.
volatility.
They don't want the volatility, they don't want mistakes, they don't want to underperform, and so they put all these constraints around their investors and around their who they hire to do their investing. And so, the institutional funds are often in a pretty small box of what they can buy and what they can sell, and how they can buy it, and how they can sell it. So Fairfax has a lot more flexibility and kind of do whatever they want that makes sense, and that's a huge advantage. And we talked about how the market's changed. Well, I think the changes that we talked about in how investing is done means that we're in potentially the most inefficient market I've ever seen, certainly in over 20 years. And we're at the point where after 15 years of this, maybe starting like a year ago or 2 years ago, some of these idiosyncratic opportunities have become so cheap. And a lot of those idiosyncratic opportunities are sitting inside Fairfax's portfolio.
Hmm.
And so you have this situation where you have stocks that are absolutely cheap sitting inside another stock that's absolutely cheap. And so that's one of the reasons why I think the expectations for the company are too low ultimately.
And it
Um,
becomes a no-brainer. Yeah.
yeah, I mean, so we should go back and so we should say on the downside protection. I think that's
Yeah.
important to go back to. I think the reason why I feel very comfortable that it's very hard for the return on equity to be certainly below 10%, but potentially even below 15% over the next 3 to 5 years, which is a reasonable foreseeable future. I think that we can talk about. I think you always have to be reassessing where returns are available based on the setup. On the current setup, because Fairfax positioned its duration of its bond portfolio so well heading into the pandemic, where they were only at 1.2 years of duration in their portfolio. When interest rates really started to spike up, they had a lot of cash and a lot of short-term bonds that were maturing that they were able to reallocate
Hmm.
into higher interest bonds and longer duration. And the real advantage of that, I think some people miss, is that because they didn't take, when maybe it's unclear, when interest rates go up on a bond portfolio, the longer your duration is, the bigger losses you have to experience. And I think that was clear in some of the bank defaults that we had in the U.S. Last year, the year before. Silicon Valley Bank, I think, was one of them.
Oh, yeah.
I didn't pay that close attention, but they effectively had some really long term bonds. Interest rates went up, and so they took a giant loss, and it really digs a hole into their balance sheet. Now, insurance companies have a benefit where they can't have a run on the bank, right? There's no run on an insurance company unless everyone gets into an accident at the same time, right? Then
Right.
you have a right, and that can happen. I mean, there's catastrophes that happen, but they insure those, but they also reserve for those. So the risk of that being an event that causes permanent damage is relatively low, right? But you are taking that risk. There's no question it is a risk. Um, but because Fairfax was positioned so well, its capital didn't get hit as hard as everyone else's, and so it was able to write more business than everyone else in a hard market. And so Fairfax almost doubled its premiums since before the pandemic to now by being able to take advantage of the hard market and write a bunch of business. And now after the market has been hard for a long time and it's starting to soften a little bit, their premium growth has slowed down, and they're ceding back some of the market share to the competitors who are now chasing it because they lost so much business, during
Hmm.
that previous period. So they're playing the game, the capital allocation game, not just on the investing side, but also in how they write insurance. And I think that's an important thing. I mean, that's why, they understand that the returns that they earn are very dependent on the price that they receive for the insurance that they
Yeah.
sell, right? Like,
Yeah. Value
the,
investors in every way. Yeah.
exactly. Like, I think it was Buffett that said, the price is what you pay, value is what you get, right?
Yeah.
And the same thing works in inverse on an insurance when you're signing an insurance contract. You're saying, hey, give me these premiums, and if if they're writing for a 95 combined in a hard market, they might be writing for double digit returns. They might be writing at a 90 combined, right?
Right.
Now we don't see the benefit of that right away because they're also very conservative on reserving, and so they will assume that these reserves last for a number of years. 4 years is I think the average claim liability. So assume that they book these reserves for 4 years. Well, because they're very conservative, and this is what the accounting requirements demand. Whenever they have an unfavorable result on reserving where they underestimated the reserves, they'll take that loss right away into their numbers,
Mm-hmm.
right? So you'll take the loss hit first. But if they are in a situation where there's only favorable outcomes, where the claims are coming up less than the reserves they anticipated, well, we start to see that benefit 4 years later.
Yeah.
And I think it's important that we are in that period now. So, and I think what was interesting about the quarter that was just reported last week. I think it's important to say that we're talking a day before the elections. we're
That
you
too.
know
Yeah.
we're talking a few days after they reported earnings, and so there's a lot of variability potentially around what we're talking about. But when they did report those numbers, they reported a bigger release of reserves than any of the analysts expected, which is one of the reasons
Mm-hmm.
why the earnings were better than expected. And it wouldn't be surprising to me that we continue to see these reserve releases over the next 4 years as we basically go over this period of hard market. So that's a potential source of where underwriting expectations for underwriting income are potentially too low going forward. Although generally they're fairly reasonable, I think, in terms of what the analysts expect.
Mm-hmm.
Um, so so because of that, one of the what's happened because they grew the insurance business so much, they also increased their float pretty considerably. So the float per share is now
Massive.
$1,700 per share.
Oh my God. Yeah.
And you have book value of 1,033. And if you go back and you Google insurance float, Warren Buffett, and go on YouTube and listen to how he talks about insurance float, you realize that insurance float is extremely valuable, right? Because insurance float is effectively considered to be a liability on the balance sheet, which means it doesn't screen well for quants, by the way.
Mm-hmm.
But it's considered to be a liability on the balance sheet, but a liability that you never have to pay back, where you get to keep all the earnings that the bonds that it buys for your retained earnings, effectively makes it an asset. And Buffett has ways of explaining that, where he talks about if someone offered him full value of the float, but they couldn't write any more insurance, he would not take it. So he would not take 1 times the float. And so when you do that math with the obvious valuation metric then to estimate intrinsic value is to say book value plus float is a good estimate of intrinsic value. Well, that's $2,700 US. We trade for less than half of that today.
Wow. Yeah.
So that gives you some idea of your margin of safety. And during that period of when the interest rates were zero, you couldn't see that float value, right? The float, because it wasn't producing a lot of interest income, the float wasn't as valuable, but it was an asset that was kind of sitting there waiting to be turned on again effectively when rates went back up again. And that's one of the reasons why the stock has performed so well over the past 4 years, because all of a sudden it's such a giant boost to ROE to have this giant float.
That's insane. Another quick thing, just to quickly add for everyone to understand, because a lot of people will say, well, insurance, it's a risky game and stuff, which it is, right? One thing that, like, an appeal for me about Fairfax is the fact that it's not an insurance in like one specific state in the US. It's a globally diversified. They have, I mean, my jaw dropped when I saw they have an insurance business in Ukraine too, which is
Yeah.
probably not the best time now to have one there. But they have, and they just bought, they got the Gulf one too, Gulf insurance,
Hmm.
which is
Hmm.
in the Gulf countries, right? Like the
Hmm.
UAE, Saudi Arabia, and all those places. They have several ones in the US. They have the UK, Ireland, like you said, right? So, and it's nice also when you read his shareholder letters, right, every year, and he gives the breakdown of the combined ratio in each of these. And it's like, okay, sometimes you'll have one that's like, 110%, which isn't great, but then it's
Hmm.
rescued by another one that is like 89 or 90%, right? So I
Yeah,
feel like
and
that's another advantage.
it's also important to think about what the conditions are in each of these markets, like the macro factors too, right? Because in some
Yeah.
markets, you might have higher interest rates, and so when you have higher interest rates, you can afford to have a higher combined ratio because your
Yeah.
total return is not just coming from the underwriting; it's also coming from the investment income that you earn off of the float. So India is a good example of that. They own a large stake in a company called Go Digit, which is a startup insurance company. One of the reasons why people don't own Fairfax is because they really hyper focus on some of the investments that didn't work out. Um,
BlackBerry.
BlackBerry is
Oh
the
my
example
God.
that comes
So
up
wait,
so much.
sorry. I have to
Yeah,
just literally every single time I have been tweeting about Fairfax, like any all the good things. I have someone who's like, yeah, but BlackBerry. And I'm like, give me a break about this. What this is like
yeah.
one thing that they did.
Yeah, and
One bad thing.
it comes down to like because so many investors have become quality investors, right?
Yeah.
When they see stuff in the portfolio that doesn't screen well, they're like, "Well, I can't buy the stock because I wouldn't buy what's in the portfolio." But I think the better way to think about it is like, wow, these guys have created a pretty special money making machine that has built in leverage where the hurdle rate for returns are fairly low in order to earn a double digit ROE.
Mm-hmm.
And if they looked at it that way, they might get past their innate discrimination. But I think ultimately it comes down to if they end up losing money on a stock where the company owned equities that they wouldn't have bought themselves, they will blame themselves for not avoiding it. So it's again one of
Yeah.
the reasons why there's a discount. But in Digit's case, I don't remember the exact numbers, but effectively, it's up almost 20 times on their cost, investing, a little over 100
Wow.
million, like I think around 150 million, and it's worth close to 3 billion now. So,
Oh my
so
God.
they created a significant amount of value in a venture investment effectively, which, most people wouldn't think is something that Fairfax does, but because they are, like I said, they're expected value investors, they will do anything. I would say that was historically true. Now I would say, I've noticed a change in the communication from the company, and I've had a chance to talk to all kinds of different people who either worked at Fairfax or now or used to work at Fairfax, and it seems like the one big change I think going forward potentially is that they are much more focused on quality. So there's no rush for them to buy quality because quality is very expensive and they're very clear that quality is expensive. But when there is another opportunity, I think of a broad-based sell-off, I think we'll see them shift a decent amount of the investment portfolio into quality, and that will potentially turn some heads because it will let a lot of people who can't buy it now or think they can't buy it now, it will give them
Mm.
permission to buy it, and almost certainly it will be at a much higher multiple than where we trade now. And
Yeah.
and we will welcome them with open arms when they come to buy it.
We will.
So
Okay, one thing about Fairfax I want to talk with you about is India. So I will say this for the podcast, and everyone knows, right? I am a huge fan of emerging markets. I think it's got to be very careful with it, obviously, right? There's lots of very bad industries or bad companies, but there are lots of amazing ones as well. India is now the most populous country in the world. It's one of the youngest country in terms of population, right? Very
mhm.
dynamic population. There's so much economic activity and really exciting stuff going on. And Fairfax, obviously, for people to know Prem, right? He came from India originally when he's like 20 years old. He came to Canada. He has very solid connections over there that he's established over the years. And if you read that short book that you gave to me, he makes that so clear, right? So he has just from his special connections there, he's had this really like amazing ability to find great businesses over there. And he launched a venture called Fairfax India. I'd love you to give a little bit of a description of what
Yeah.
they do. Yeah.
Yeah, so Fairfax India is a effectively a closed-end fund, for lack of a better word. It's an investment company that was listed in 2014 by Fairfax, where they effectively launched it as as a public fund that has economics similar to a hedge fund, where they have a management fee that they collect, that's between 1 and 1.5, depending on if the assets are invested or not, and they charge a performance fee for that. And I think the trends that we talked about, and what's happened with markets have affected Fairfax India as well, in the sense that when it started, everyone wanted to invest in Fairfax India, and it traded at a large premium to its net asset value. And Fairfax India took advantage of that by issuing equity so that they could make more investments in India. And then starting around 2018, as money kept flowing out of closed-end funds and out of companies that aren't in anyone's benchmark, and so on, the discount to NAV grew pretty substantially. And since they launched, they launched at a $10 price, like a lot of new funds will launch. 950 would be the equity after the fees, so you're starting from a discount already to the IPO price. But since then, they've grown the book value from 950 per share to around 2175 or so at the end of September. And despite that, the share price has only grown to about just a little over $15.
Wow.
Because so you have this giant discount that you're trading to the book value, and they're very clear, and I think it's very clear if anyone does any analysis in the portfolio, that the book value is a large discount to the intrinsic value, because as we've said a few times, Fairfax is fairly conservative in how they mark things. And if you go through the portfolio at Fairfax India and you see some of the discount rates they're using, they're such big discount rates that it's pretty clear that the portfolios actually, the private stocks in the portfolio are also undervalued. And that's an important thing to note, is that portfolio has, I believe it's more than 2/3 are private investments.
Mm,
And so as a result, the mark to market, doesn't really tell you what the true intrinsic value is. It's just like, we talked about carrying value and fair value at Fairfax at the parent. The same thing holds true at Fairfax India. The carrying values are significantly lower than arguably is the fair value. And we won't know until they do transactions that release some of that value, and then we'll see what the true value is. The benefit of them being so conservative on the valuation is that the fees that we pay are lower until
mm,
they mark it up. Now, that being
right.
said, anyone who buys the stock now has already paid the performance fees up to 21 and change, because that's what the stated book value is, and that's what the performance fees are accrued at. So if you're buying it at a big discount, you're getting a double discount. You're buying it at a big discount to the book value, and then an even bigger discount to the intrinsic value. And there's one investment in particular that makes Fairfax India extremely interesting right
The
now,
airport.
is the airport.
Yeah.
Exactly. Yeah. So the Bangalore airport, which they call BIAL, is their acronym they use for it, um, is marked at, I believe, around 2.8 billion in the portfolio, and Fairfax owns close to 60% of it. That would be the part that's attributable to Fairfax India, and they've been talking about doing an IPO of that airport since 2021, and I won't get into too much detail as to why I think that hasn't happened yet, but it seems that it has a lot to do with the ability to get approvals at the state level for the IPO, and potentially just some complications around in red tape around getting the IPO done. Now, that all
Hmm.
being said, you know, this year at the AGM, they talked about how, post the election, there's the potential for this IPO to happen by September of 2025. And, each of the past few quarters, they have disclosed that they're doing a best efforts to take the airport public by September of 2025. Now, by a lot of accounts, the value of the airport should be significantly higher than where it's marked. And if you read the the shareholder letter from last year, they suggest that the airport's marked at 9.5 times normalized free cash flow, which is extremely low if you do any relative comparison to other airports.
So
And that,
cheap.
so
And sorry, I gotta
yeah,
just jump in.
yeah,
Forgetting the fact that they've done a lot of work to improve that airport. It's one
absolutely,
of the fastest, if not the fastest growing one in India, which is one
yeah,
of the fastest growing countries in the world. Do you know what I
yeah,
mean? Like
yep,
it's
yep,
crazy. It's like super modern too, because like very new. Like
yep.
it's just like the
It's
dream, basically. I was looking
yeah,
at there's so many like I just spent like a whole afternoon just watching videos of people going to the airport. Like it's very exciting and very valuable asset. So yeah, no, the minute
yeah.
they crystallize that, it's gonna be
Yeah, I think I
crazy.
think I think I think it has a quite a few benefits. So first you have the initial impact of, writing up the book value up to the IPO price, right? So you get a big markup in the book value when it's IPOs. But then, it's possible that they can use the company that will hold part of the airport called Anchorage, which is what they're trying to IPO, as a tool to do other acquisitions. So to raise capital around it so they can buy other infrastructure assets in India. And so it becomes a growth vehicle where they actually have a cost of capital that's competitive and is low enough to do acquisitions that are accretive. And one of the major problems with Fairfax India is that it can't raise new capital because it trades so far below book value.
Yeah.
One of the big advantages I think that's important, because I think when people look at Fairfax India, you'll see a lot of people, advisors and so on, will recommend India, and then they'll recommend an ETF to get exposure to India. And so ETFs have taken a lot of market share from people who might have otherwise invested in Fairfax India. But what one of the things that they miss is that because it's part of Fairfax, they have access to relatively cheap leverage. And so Fairfax India has a large loan at a very favorable interest rate because it was done at a time when interest rates are lower. They're borrowing at 5% for a few more years, and that cheap financing and that additional leverage offsets the management fees effectively if you actually like do the math.
Hmm.
So even though the major complaint I always hear about Fairfax India is that no one wants to pay the fees. Value investors are cheap by definition, and so they want to avoid paying the fees, the management fees, but they don't realize that they're getting an offset with the leverage. And if they were to buy other companies, they're also paying, or they were to have other fund managers, they would also charge a large fee, and so you're getting the expertise that's really only paid if they perform ultimately. And so I think, and because you're buying at such a big discount, you're getting a big advantage over buying an ETF, I think. And so you have some of the smartest guys in the room making these investments for you, and that's valuable. Unfortunately, I think people don't want to pay for it. Now, I think there's a bit of the narrative is we don't want to pay the fees. The reality is it's not anyone's benchmark, and the stock isn't particularly liquid. There's no analyst estimates, so quants don't care. So you have institutions don't care; it's not anyone's benchmark, and quants don't care; there's no estimates. And so ultimately, you get a stock which is kind of an orphan. And they've taken advantage of that by buying back, I think, around 30% of the float over the past since 2018, since the discount started to appear. And they've taken a break recently. And I think one of the reasons why they've taken a break is because they have investment opportunities in India that they would prefer to put the capital in to buying
Hmm.
those, and because the IPO is coming soon for the airport, and perhaps they don't want to be seen as front running that to a certain extent, and getting people out of their positions at the expense of as them being the ones that take advantage of it, as opposed to someone just deciding to sell because they need the liquidity, or quite frankly, I think most of the time people selling Fairfax India is because they're frustrated and they're ready to move on and find something else. Um, but that being said, the opportunity seems like there's big opportunities for catalysts. I get the question a lot. Which is better, Fairfax or Fairfax India, and they're so different. For myself, I own golly like 14 times more Fairfax than I do Fairfax India.
Okay.
you
Yeah.
know, Fairfax is a 42% position for me. So for the
Oh
three,
wow,
the
that is
3%,
conviction.
yeah. And
Yeah.
I don't suggest anyone else do what I'm doing, but I've read a lot of Munger and a lot of these guys when
Yeah.
they talk about when you have a idea where you have a lot of conviction, you should bet big.
Yeah. Go for it.
And
Yeah.
something I wouldn't have done 10 years ago that I'm doing now. and we'll see how it works out. I can afford to take risk, and because of that, I'm taking more risk. The bigger my portfolio gets, as opposed to less risk.
Yes. Yeah.
Because what I'm trying to avoid is having to work for someone else again.
Yeah.
Involuntarily. Voluntarily, if the right opportunity comes along, I would consider doing it. But involuntarily, I don't really want to be put in that position. But yet, I'm still making this, really large bet. But I would say that, to think about how you should think about the two of them. I think when you look at Fairfax Financial, it's got the potential to, grow its ROE 15 to 20% a year, probably over the next 3 to 5 years. Is probably a good range, to think what the average ROE is going to be over that period, which means over a 5 year period, you double your book value. At the same time, given that we're trading at 1.2 times book, there's potential for pretty large multiple expansion, right? Because if you
Yeah.
think that we actually
Doesn't
do average,
Intact trade at like 3 times book value or some
yeah,
crazy number like that?
yeah, Intact Financial trades at 3 times book value. And look, I don't, I think it's fine. It trades there because it has such a defensible position in the insurance markets, especially Canada, where it operates. So it enjoys a much better combined ratio in theory
Mm.
than most companies. Now, because they're in personal lines, and catastrophes have been up a lot in Canada, they haven't earned they haven't earned the right, I don't think, most
Yeah, good
recently,
luck
to,
with
to yeah.
Jasper and all those places.
Yeah, and
Yeah.
they took a really big hit. And I think by the time this comes out, they probably would have reported their quarter, but they've already disclosed that they're taking about a $5 per share hit,
Oh,
to
wow.
their book value, which would take their book value from like 88 to 83, and then whatever they earned in the quarter would be added to that. So maybe they'll end up around $86 book value versus that $270 share price. So yeah, it trades at and it trades there because it's considered quality, right? Like it has
Hmm.
the earnings growth. The earnings growth is, the analysts are all pretty tight range on what they expect earnings to be, because it doesn't have the equity investments that Fairfax have, which adds a lot of volatility to the earnings stream.
Yeah.
And so there's the analysts are very certain that a 17% ROE is possible, and that's enough to keep the multiple. And their stated strategy is to do acquisitions, and so when you have a price to book at 3 times, you should tap that whenever you get a chance, right? You should
Yeah.
raise capital, and you
Of
should buy
course.
stuff that's a lot cheaper, because it'll certainly be accretive. And so, and the management team there is exceptional. So it's a great company. It's a quality company. It just trades like a quality company. And whereas Fairfax, I think, is, like we talked about, quality that's hidden by sort of more volatile earning streams, and sort of no desire to sort of play the adjusted earnings game that their peers do. And so they don't really sell to the street. They just tell you, here are the numbers, and you guys decide what you want to pay for us. And
Yeah.
if you don't like it, then we'll buy back the shares ourselves, which they have done, right? They've bought back,
A
you know,
billion. No. Yeah, $1 billion worth this year,
in
right?
the last year. But I think if you look at since 2019, I believe the share count has gone from 27 million to 22 million. And
Wow. Yeah.
and on top of that, they entered into total return swaps for almost 2 million shares.
That's like the best investment.
Um, it's
Yeah.
been a phenomenal investment with no upfront capital.
Yeah.
That investment has made almost $1,000 per share on those 2 million
Yeah.
shares. It's
So
a
wait,
remarkable thing.
sorry. Also for our
Yeah,
listeners, let's explain that, because I had to like chat GPT,
yeah,
what is that when I first started reading about
yeah,
total return swaps.
yeah,
Can you explain to for everyone what that
yeah.
is,
Sure,
how that
sure.
work?
So
Yeah.
total return swap, effectively. I guess what's a good way to explain it, because it is a
It's a bit
confusing
weird, isn't it?
it's a bit
Yeah.
confusing, but effectively, without putting any upfront capital, they effectively get exposure to the share price above a certain price and below a certain price. So whatever the stock returns, um, they get to capture into earnings. I can't remember the exact price that they put it on, but let's say they put it
Very
on
low.
at
Yeah.
$400 US per
Something like that.
share.
Yeah.
They put on these total return swaps, and the stock goes from 400 to 500. They make $100 per share that was in the total return swap, and they have 1.96 million shares, call it 2 million shares in the swap. So they make $200 million on that investment, effectively, on the change in price. And the way it works, actually, like, in the numbers is that their account will get credited with that capital, and a certain amount of the capital will have to leave with the bank to cover if there's a decline. But otherwise, they get to take the capital out and use it for whatever they want. And so that delta, because it's done this way instead of a buyback, gets included into earnings, which is important. And we can talk about why that's important a little bit later on. But that's effectively the how a total return swap works. Now, a lot of investors got scared away from it because they're like, financial engineering. I don't like financial engineering. But Fairfax basically looked at their stock price and said, we know we're way too cheap, and we know what the earnings forecasts look like because we can see what interest rates are and we can see how much float we have, and we know all of our stocks are cheap. So they had a good idea that the book value was going to go up, 3 to 5% a quarter for as long as they could see. And so it was an easy decision to enter into the total return swaps. And it was at a time where they were growing so fast in the insurance markets that they didn't want to pull capital away from the insurance markets to do share buybacks. And so they did a total return swap instead, right? They're very creative in how they take advantage of capital markets, And another example of them being creative is they sold, 10% of one of their large insurance companies, Odyssey Re, to the Canada Pension Plan, and I believe OMERS. And they sold that at a 1.9 times book value when their stock was trading below book value, I think around 0.9 times book value. So they realized a giant gain on that sale, and they took that cash and bought back 2 million shares at US 500 just a couple of years ago. And now the stock, like we talked about, is US 1300. So they, that purchase made another $800 per share on 2 million shares. So another 1.6 billion of value for equity holders because they did that deal. So they're very creative in how they do these things. And so when you think about Fairfax, they're in a position now where if they, just if they reported, 8 years in a row of 15% plus ROE, which we've had 3 years already, 2024 will be the fourth year of a 15% plus ROE. If they do that for the next 4 years, which again seems likely because of the positioning of the bond portfolio, the positioning of the underwriting, given we have all these reserve releases and they're slowing down premium writing as the market softens a little bit. And because the equity portfolio is too cheap, all these reasons, like the 15% ROE seems very, very likely. I call it like a 90% probability that they'll earn north of a 15% ROE on average for the next 4 years. Notwithstanding there might be individual years where there's a giant catastrophe loss or a giant hit, something possible. Unpredictable that happened. You have to account for that. But if it's a hit in the insurance business, they'll just be able to, the insurance market will get hard again. They'll write a bunch of new business and you'll make it back up over time. So it's not really a concern. And actually, those kinds of opportunities are actually really good for a company that is really strong financially, like Fairfax is. So they're most likely going to do that, in which case they'll have booked 8 years in a row with 15% type ROEs. And when you do that, you create a lot of what I call social value, because people are like, these guys are so good. Why would I ever sell these shares? And so you get what's called what I call a reluctant sellers, a bunch of people who are just like, which I am one. I'm like, I don't want to sell any until I see the forward ROE is going to be less than 10%. And even then, I'll think about why that's happening, before I sell. And what Fairfax has, which is really special, is that it's still not in the TSX 60, which is the largest index in Canada. It's the equivalent of the S&P 500 in the US. Both the S&P 500 and the S&P TSX 60 are part of the Global 1200, which is an S&P index. And so Fairfax, despite being the 25th biggest company in the composite, which just happened today, by the way, because BCE was down 9%.
Yeah, I know. Oh my God. Yes. Oh, it's insane.
And Fairfax was only down 4.5% after being up 9% on Friday. So it passed BCE today. So it's a 25th biggest company in Canada, but it's not in the 60. And it seems pretty clear that the index committee, which decides what goes in the benchmark, has sort of tipped its hat that it will add Fairfax in December, as they invited all the brokers in to talk to them and said that size matters more than sector representation. And a lot of the brokers in September were saying that it would not be added to the index because the financials were too big in the 60 versus the composite, and then that sector representation is super important. But if you read through the guidelines, size matters more than sector representation. And that's the message that the index committee had to these brokers. And so since then, we've seen a lot of brokers start to highlight the possibility of Fairfax going into the index in December. And what that does is it causes buying of up to 4% of the shares outstanding, which might be 800,000 shares of the float. 4% of the float, I should say, not 4% of the shares outstanding. 4% of the float, which
Hmm.
would be around 800,000
Oh, wow.
shares. And when you compress a lot of buying into a very short period, it doesn't give time for people to sell their shares. Quite frankly, because people, a lot of investors are very responsive to price. They don't think about value too much. They think, I'm up a lot, I should sell some. And so you get that kind of action, but when it happens really fast, it's harder to get those shares out of them, or a lot of shares out of them. When it happens slowly, they're more likely to trim along the way because they're always
Right.
afraid of giving back, gains. And so you have this index ad component, and on top of that, if you look at all the major funds in Canada, especially the bank funds, who are real asset managers, who are all closet quants, essentially, they don't own Fairfax. And when it goes into the 60, all of a sudden that changes the calculus of whether they own it or not. Because for a lot of these funds, they are benchmarked against the TSX Composite, and in order to beat the benchmark, they own the best names in the TSX 60 because
Hmm.
they're considered the highest quality names. And so if you own the biggest 60 or the best 50 out of the 60, you have a really good chance of outperforming the composite. And so it's a way most money is run. Again, not focused on absolute returns, focused on relative returns. And so I think a lot of these funds that don't own it are going to have to consider it either when it goes in, before it goes in, after it goes in, or eventually when they finally can't take the pain anymore of underperforming effectively. So you have these source of buying that is not really focused on value. And most of the buying in Fairfax has all come from value investors so far. And so the buying that's going to happen now is going to come from where price or value is not a factor effectively. And so there's a real chance that you can get some big multiple expansion. And that's not to say that when that multiple expansion is done, the stock will be expensive. We'll have to see what the returns look like at the time. But one of the most exciting things about this, when you look at the portfolio, is that we're kind of underwriting sort of 15% type ROE, but because there's so many interesting things in the portfolio, and because there's so much optionality, the opportunity for them is to beat that 15% ROE, I think, by a wide margin. I think the way I'd like to talk about it is that the odds of book value compounding at 10% a year over the next 5 years is lower than them compounding at 20% a year for the next 5 years. And so when you
Wow.
have
Yeah.
when you have this kind of right tail potential, and you care about absolute returns, not relative returns, you're saying, well, I'm happy if I earn 10% a year because that's long-term equity returns. But now I have access to 20%, type returns. That also could happen. And the multiple could also expand, from, 1.2 times, 1.3 times now to 2.5 times, maybe even 3 times.
Hmm.
And we saw this happen in the late 90s with Fairfax. In the late 90s, if you go back and you look at what they reported 4 years in a row of 20% ROE, and the price to book multiple started at around 1.8 times, way higher than we are now, and went to almost 6 times.
Oh,
And
wow.
here,
Seriously.
yeah, oh
There,
yeah,
I
yeah,
bet. So I haven't read this yet, but I'm
yeah.
sure in his letter he must have said, "Oh, I think the stock's overvalued." He probably even said that himself, right?
Yeah, I
Did
don't know.
he?
I don't remember if they said it was overvalued, but they issued a lot of stock,
Okay, yeah.
right? And that tells
Wow.
you
But that
and,
shows how
it was a
smart they are.
yeah, it was the same
Yeah.
time that Berkshire Hathaway was buying Gen Re.
Hmm.
They issued stock to do that deal, and Fairfax was doing the same thing. They were issuing stock to buy insurance companies, and so they were taking advantage of the valuation to make the company stronger and set it up for growth, because it's so accretive when you issue equity at a really high premium to book value. You're
Yeah.
effectively issuing it more than intrinsic value. Now the after effect of that is there's all these new shares outstanding, and then the performance kind of suffered because that ROE was based
Right.
on equity returns in the portfolio doing really well. The equities were doing really well in the late 90s, and they were positioned really well for that. And so they weren't able to keep up that momentum. This time, you know, there's way more stability because the float is so big compared to the book value. The bond portfolio is 49 billion, and bond and cash equivalent portfolio is 49 billion versus the equity of 23 billion, right? So
Mm,
the equity portfolio is another 20 billion, and a lot of those positions aren't mark to market. They are
yep.
ownership positions where they're taking in the earnings. And so when you look at some of the holdings like Eurobank and Poseidon, and the TRS, those three positions take up less than $200 per share out of the $800 per share that the equities are.
Wow.
So
Yeah.
you have, and those three together will already earn you a 5% plus return. And so, you're already at a 15% ROE. If the fixed income portfolio is earning 5%, which is two thirds, and then the last one third, if it's earning 5% just on the back of three investments, the other $600 per share of equities might actually return something, and if it makes,
Yeah.
5%, then you beat consensus estimates by $30 a share. If it makes 10%, then you beat consensus estimates by $60 a share. So the earnings upside is gigantic. And you start talking about those types of numbers, well, $200 per share of earnings is your 20% ROE, right? So you can get there
Yeah.
without a lot of, without the equity portfolio actually doing that much, but it might do a lot.
Very much. It could,
Yeah.
yeah, like you said, the upside is enormous. One thing that I'll say for our listeners, I know they'll appreciate that. So I don't know if you know this, you should know this probably, right? But most people who follow me because I love another company also called Brookfield, right?
Mm-hmm.
Now, Brookfield and Fairfax, obviously very different companies, but they have some big similarities in terms of how they like to have optionality and just the thing that some people say in a negative way, the financial engineering, but is actually a good thing, that they are just, using creative ways to create value for people. I
Mm-hmm.
don't know if you saw this, that Brookfield's doing that right now, but they're moving their asset manager to the US for the
Mm-hmm. Mm-hmm.
exact same reason, to get it included in all the index and all that kind of stuff, right? It's just like these guys, even if it's totally different company, there is that similar value driven and very smart and optionality type of DNA in them that I really like. And then just to quickly go back on Fairfax India for 1 second, because I can definitely picture some people listening to this episode and be like, oh, why is this even a thing? Well, I would point them to the Brookfield subsidiaries, like Brookfield Renewable, Brookfield Business Partners, Brookfield
Mm-hmm.
Infrastructure, right? It's a very similar type of setup, right? So,
Yep. Yep. I think
um,
I think a good comparison for Fairfax India is BBU.
yeah, that's
Um,
exactly it. As you were talking
yeah.
about it, I was like,
Yeah.
that's it. And by the way, BBU now is doing a lot better. Like they've really consolidated a portfolio. I think they said their top five, no, the top 50% of holdings they just bought in like the last 3 or 4 years, and they're
Mhm.
doing extremely well right now. You know what I mean? So it's very
Yeah.
similar
I
type
mean,
of
we
setup.
didn't close that loop on comparing the two. We started talking about how well Fairfax could do over the next 5 years. So when
Yeah,
you do that math, you can see how you can make 20 to 40% a year is not a crazy number for the next 3 to 5 years, right? Which is a crazy,
yeah.
you're multiplying your money pretty aggressively when you do that. The compounding effects are huge. When you think about Fairfax India, it could grow its book value faster over the next 12 months because it's got these catalysts in terms of the airport potential IPO. And there's some speculation that Fairfax is one of the final bidders on a large bank in India. And if that happens, it's possible that Fairfax India would be involved
Mm-hmm.
in a capacity where it potentially could create a lot of value for Fairfax India, where they're the GP and they bring on different LP investors, including the Fairfax parent. Maybe someone like Brookfield would want to invest. So there's a possibility that they create a lot of value from a transaction like that. So you kind of have like a few ways over the next 12 months where you could see book value go up 30% plus, and maybe a new earning stream generated from a deal around IDBI. So that's why I think owning both makes sense.
Mm-hmm.
Uh, but because Fairfax parent is in the index, and because it's going to another index, and because people are forced to care about it, quite frankly, because
Yeah,
it's in their benchmark, it's much safer, I think, in terms of, or
I
the
agree.
expectations over the next period. It's much more diversified as well. So if you're invested only in India, you're taking risk with India. And India, I think like you talked about, it's the most populous country. It's the largest democracy. It's positioned strategically in a world where it's kind of important to everyone.
Yep.
no matter what superpower you are, you want to be friendly with India as a counterbalance to China, quite frankly. And India also needs, Russia and Japan and, Britain and the US and Canada, all, maybe not Canada as much anymore to be
A bit
friendly.
less, yes.
But I think that can get solved, over time.
I think so
But
too.
but there's these large diasporas in that of Indians all over the world. I mean, the next U.S. president might be half Indian, of
True.
half Indian descent as well. So there's India has a lot more soft power than it ever did, and I think the internet has made it much easier for people to be productive, and it's a very large population, and a population who has the potential to really create a lot of value over time. So when you think about both investments, like keep Fairfax India a bit smaller, I think, and I really like the Fairfax more, the parent more, but I think they're both good investments, and that's why I do on both.
Yeah, love it. Definitely a great setup. And again, for our listeners, if you like Brookfield infrastructure, you should look at Fairfax India in a similar way because the setup, the relationship is similar. And also this thing about the fees, because again, the Brookfield subsidiaries also pay a fee to the asset man. It's
Mhm.
literally the same thing, right?
Yeah,
But
yeah.
no one would be like, oh my God, I cannot buy, Brookfield Renewable because they pay a fee to Brookfield Asset Management, right? It's the
Yeah,
same
yeah.
thing. So,
No. If I seen you had a dividend, I would change it.
mhm,
There's a bunch of things that can bring in investors that otherwise wouldn't be there.
yes,
But when you think about Fairfax India and that in this right tail possibility on the airport, well, a bunch of that will bleed into the ROE at Fairfax the parent as well. So that's
yes.
you can see that's one source of how they can beat the expectations. And there's so many other things in their portfolio that are interesting. And some are, you can go through a list and see what's in the financial statements. They list all of their large investments, but some of them, are kind of hidden. And one of them I'd like to share is Strathcona Resources,
Yes, let's
if
talk
that's all right.
about that.
Yeah.
Let's get into that.
So Strathcona Resources is an oil sands company that went public last year via reverse takeover, and if you do a little bit of detective work and look at what Fairfax disclosed in its financial statements at the end of 2020, 2022 and the end of 2023, you'll notice that they had a large investment in an energy company, and and after it went public, they had to take a big markdown. After Strathcona went public, they took a big markdown on that position because it was marked at NAV, and when it listed at close to half NAV.
Oh wow.
So people weren't willing to pay NAV in the public markets for again a lot of reasons that have nothing to do with I think have nothing to do with intrinsic value. The the way it was structured, and I guess I should say the Strathcona is 91% owned by Waters Energy Fund, which is managed by Adam Waters, who used to be the former head of investment banking at Scotiabank, and he is, from what I can tell and everything I've read about him and I've heard him speak, he seems like a brilliant investor, a brilliant capital allocator, and he had an idea to start an energy closed end energy, or not closed end, but a private equity fund to invest in energy. And effectively since 2017, I'm taking this quote from them, but you could argue that they are the most successful startup in Canada in the past 15 years. From 2017 on $2 billion invested, they already have retained earnings of $2 billion.
Oh wow.
So they've doubled their money
Wow.
invested on a retained earnings basis in
Yeah.
7 years, and the net asset value is over north of 10 billion. So they've created a significant amount of value in a very very short period of time, and they only listed recently again via reverse takeover. And because Waters owns 91% of the shares, the public float is relatively small. And I think one way to sort of beat the market, I think, or to I shouldn't say beat the market, but generate absolute returns that are reasonable and above expectations, is to try to take advantage of the market's quirkiness. And one of the things that, because it's not very liquid and because the float's too small for the benchmark, institutional investors don't really think about it too much.
Right. Right.
And so until it goes in the benchmark, you know, it has the potential to stay undervalued. And Waters knows this. And most investors, you know, when they look at a company in this situation, they um, they assume that the private equity fund is going to do secondaries. So they're going to issue equity to the public market. And when they do that, they'll do that at a big discount to the last trade. And if you're an asset manager, you don't want to own a stock when it issues equity at a big discount because it's a big drawdown.
Mm-hmm.
And whenever you have a big drawdown, you have to explain to your investors why you had a big drawdown.
Yeah.
And
No
it's
one wants
just
to have to do that. Yeah.
yeah, it's not worth the pain. Let's just own C and Q instead, right? It's just
Yeah.
easier, you know. And so, but as it becomes so instead of doing that, instead of issuing equity and doing a bought deal, what it's called a secondary, instead what they can do is just pass on their shares of Strathcona from the Waters Energy Fund, which is the 91% holder, to their LP holders, of which Fairfax is one. You know, so I
Okay.
estimate doing the math that Fairfax owns something like 7 to 7.5% of Strathcona, and Strathcona has 214 million shares outstanding, and the stock trades around 28. So it's a little bit less than a $6 billion market cap. But again, the float's only 9%, so it's less than $600 million float. In order
Mm.
to get into the index, the float has to be something like 1.4 billion. And so what Waters has said is that, you know, at various times over the next 3 years, they will distribute shares from the LP holder from the fund to their LP holders. And if the LP holders just hold on to their shares, the float goes up enough that it'll get added to the benchmark. Now, some LP holders will sell because they need liquidity or they don't like being marked to market or whatever it may be. But Fairfax is one of those I assume who is not going to sell and they will hold
Yeah.
on, and there'd be
Yeah. Yeah.
others
Yeah.
like that in their portfolio. So I can envision a scenario where they distribute, you know, 13 to 15% of the shares to the LP holders, and then they tap into what's called a substantial issuer bid to try to help any LP holders who have flowback who want to sell, so that the stock price doesn't get hit very hard if they do want liquidity. But what that will also do is get the stock added to the benchmark. And so I think there's a mechanism here to solve for why people don't want to own the shares. But we should say that the stock is also very cheap, you know. So
Yes.
it trades for around a half of NAV, 1p after tax, 10%
Wow.
NAV, and they have a plan now to distribute all of their free cash flow to shareholders either via buybacks or dividends. And so they started their first regular dividend in August. They're paying 25 cents a quarter, $1 a share, so it's just over a 3% yield right now. But if you look at their presentation, they show what their free cash flow is at various oil prices in 2024, and at $80 US oil, it's that it trades north of a 15% yield, and at $70
Wow.
oil, it's closer to a 10% yield. So you have this potential for a 10% dividend, 10 to 15% dividend, depending on between where we are between 70 and 80, and we could go lower, but their costs are significantly lower than that. Um, and and on top of that, you have 5 to 7% type growth as well, because they have a reserve life index of 38 years because it's oil sands assets that they can accelerate up to down to 24 years over time, and that's still a very very long time, but it brings forward a lot of these cash flows that are later on forward, which really increases your NAV, increases your production. So if you think you have a 10 to 15% dividend yield, shareholder yield, plus 5 to 7% growth, you can see how you get 15 to 20% growth a year. And
Yeah.
so and so for me, this has become another investment where I want to own it for a very long time. And what's doubly exciting about it is not only do you have this setup, you also have them being very aggressive and acquisitive, and there's a potential deal brewing where because Waters Energy Fund signed a deal to buy 43% of a company called Greenfire Resources. from three of its biggest shareholders. And Greenfire is another oil sands company in Canada that's much smaller, that only has one significant asset, whereas Strathcona has a lot of different assets, diversified. And Greenfire, after it was announced that Waterous had signed a deal to buy 43% of the company, announced that they were already pursuing strategic alternatives, and that they were trying to sell the company. And actually, tomorrow, November 5th, there's a hearing at the Alberta Securities Commission. And so by the time this comes out, we'll probably know the result. We'll find out the result on November 7th as to what they say. But the company, Greenfire, is trying to stop Waterous from buying the 43%.
Huh.
And to limit them to buying less than 20% by issuing a shareholder rights plan. And Waterous is fighting against the shareholder rights plan. And so we will see what the result of that hearing is. But regardless, I think effectively what Waterous did as a good partner for Strathcona is set it up so that it turns the acquisition of Greenfire from a bidding war potentially into a negotiation. And when you do the math, you can see how Strathcona could pay a very large premium to Greenfire, and it would be accretive still to Strathcona. And the Greenfire shareholders will then get a much more liquid asset, or will get increased liquidity. Greenfire is actually more liquid than Strathcona, but it's a win-win. Yeah. They'll get a dividend right away. All that shareholder return will come from them, and so on their cost basis, it's a tremendous opportunity. So I position myself to own, almost 5% each of Strathcona and Greenfire, sort of equal positioning, because I don't know what the order of operations is going to be, is how this is going to play out. But Greenfire is definitely pursuing a sale, and it should find a buyer north of where we trade. The price that Waterous agreed to pay for the stake is around almost $11 Canadian, and the stock is it was up a decent amount today, so it might be like 10.40 or something Canadian. So you're still trading at a discount to that price, which is the cash price. But I think ultimately, one of Strathcona's plans is to issue equity to do deals. In order to do that, it needs a higher equity price, and so I think there's a chance that Waterous will try to get its share price up before it actually makes a proposal to Greenfire's board. Mm-hmm. And on that basis, they announced their first investor day, which is going to take place on November 14th in Calgary, and I'm going to fly out there next week to visit with Greenfire and with Strathcona at their investor day, and see what they have to say, and ask questions, and just try to understand how they think about things. If they're thinking about it how I'm thinking about it, which I'm hopeful that they are. In which case, I think you have this setup where they have the investor day, they explain to everyone why they're so great, and you get some buying that comes in, and then they could issue those shares to their LP holders whenever they want. So why not do it at the end of November? In which case it would qualify for the index in December, and so then you have index buying on top of that coming in, and so I don't know where that will take the share price, but that might be a better negotiating position than to make an offer to Greenfire that offers a big enough premium that makes everyone happy with the deal. And so that's the sort of event driven / long term trade, and I think owning both is a way of getting some of the Strathcona shares cheap via Greenfire potentially, or just owning Strathcona outright. Both I think have a chance of doing really well. If Strathcona ultimately does not end up buying Greenfire, someone else will for a large premium. I'm almost certain.
Yeah.
And so this is again a situation where it's probabilistic investing, right? We don't know the outcome, but we're making a bet based on I'm making a bet based on the circumstances surrounding the transaction. And there's history of Waterous buying buying a large stake in a public oil sands company and then merging it eventually with Strathcona. They did that a few years ago with a company called Osum. They acquired 45% of the company from 3 different buyers. That company took them to the Alberta Securities Commission. The Alberta Securities Commission said it's fine. They're allowed to buy it. So I don't know how this outcome is going to be, because it's a little bit more complicated, because in that case, the 3 shareholders that they bought from didn't have board representation, even though they had access to all the information that the board did. In this case, the chairman of the board was also one of the sellers of Greenfire, and so it's a bit more complicated. and I'm not sure if the ASC will be focused on the fiduciary responsibilities of the board, and did they circumvent a fair process for Strathcona by agreeing to sell the stake, a fair process for Greenfire by allowing them to buy the stake, and effectively get negative control. So
Right.
we'll see what the outcome is. It's still up in the air, but I think it's a very exciting situation where, again, I find
Yeah.
it really hard to see how we lose money, and
Yeah, yeah, yeah. No, it's very compelling. Just to quickly jump in,
yeah.
I really like that you mentioned again this is like a probabilistic type of
Mhm.
like event driven, and to me this really shows there are so many ways to make money investing that people don't think about, like this kind of arbitrage thing, right? This is
Mhm.
like
Mhm.
totally different from what we were talking about earlier, like value investing and growing earnings and all this kind of stuff, right? Which is more old school traditional, which is more kind of how I invest. But the way that you're describing this whole thing for investors like you who do the research and who really know their stuff, it's the probability of making money with this kind of stuff is extremely high, right?
Right.
So
Good.
that's yeah,
Well,
that's
also, well,
awesome.
also, it's still value based though, right? Because you're
Yes,
looking at, well,
right.
what's this worth?
Well,
What's this
it's
worth?
everything together. Yeah, yeah, yeah. Like
Yeah,
of
and
course
how
the
and how.
half of NAV and
Yeah.
all of that. Yeah,
Yeah.
yeah. I don't
Yeah.
want to discount that.
Yeah.
That's
Yeah.
definitely a
Yeah.
big part of the equation.
Yeah.
But I think having both of those things together makes it like almost impossible to lose. Do you know what I
Right.
mean? Because
Yep.
like you have the value and the event at the same time. So yeah, that's really cool. I will say though, for our listeners, not financial advice.
No,
I just
yeah, no,
yeah, yeah.
no, no financial advice. I make sure
But
that's clear. I
that's
don't sell anything either. I want to make that clear. I don't have a
yeah, yeah, yeah.
business. I don't sell anything. I like to share my ideas because I like the feedback that I get. It
Yeah.
helps me
And you have great
understand
ideas.
what I'm
Yeah.
missing,
Yes.
if I'm missing anything, and also like, maybe it'll help someone make some money potentially. Now, I've been wrong plenty of times. I think one of the things, like when we talk about the difference in how investing used to be and how investing is now. If you look back at some of the old quotes from like John Templeton, and Peter Lynch, they used to say, like, if you're right 6 out of 10 times, if you're right 2/3 of the time, you're one of the best analysts out there, right? And
Mm-hmm.
that was kind of the basis for, that holds true in a probabilistic style of investing, because you're taking a lot of execution risk, you know,
Yes.
and so what's happened in the past 15 years is that people want to minimize execution risk, and so that's why they've diverted to more quality. And so their actual hit rates, I think, are a lot higher, in terms of the company continuing to grow. Now, the price they pay is a totally different thing, right? But
Mm.
but over time, with high quality companies, and I think there's a Munger quote that talks about this. If you have a 15% plus return on invested capital, and you buy at an expensive price, well, over time you'll make up the difference fairly quickly. But if you buy a poor business that has low returns, even if you buy it cheaply, at best you're going to earn those low returns over a long period of time. So it's a
Yes.
really important
Mm.
distinction. So it's not a knock on these people who have chosen this path, but I think it's gone to such an extreme that there's all this other stuff like Fairfax and Strathcona and Greenfire, and all kinds of sectors that don't sort of match in, and Fairfax, to their credit, takes advantage of this kind of stuff. I mean, they own Strathcona, right? They decided to take that plunge with Adam Waterous because they really like to partner with good management teams. They own a gold stock. They own, Orla Mining, which is a gold stock that's listed in Toronto. I don't own Orla because it trades more expensive versus where I see other gold stocks trading. My biggest gold position is a company called Mako Mining, which, on my math, trades at something like three times 20, sorry, 1 times 2028 cash flow, maybe three times
Wow. Yeah,
4 12 month cash flow, because the gold price rather has taken off,
that's true.
and
Yeah.
the stock hasn't. And again, it's another situation where it's not anyone's benchmark, it's illiquid. But the similarities between Fairfax, Strathcona, and Mako is that they all have large shareholders with a lot of skin in the game. Fairfax has Prem, obviously. Strathcona has the Waters Energy Fund and Adam Waters himself, who benefits directly from the performance of Strathcona, earns a performance fee based on how well it does, which I understand they're going to take in shares when they take it, so they'll continue to be invested. And Mako is effectively controlled by a company called Wexford, and Wexford is the investment fund that started Diamondback Energy in the U.S. And Diamondback
Hmm.
Energy, they started in 2007. They took it public in 2012. It's returned north of 20% a year. I think 24% a year
Wow.
since then.
Wow.
And it's now like almost a $60 billion market cap.
Oh my God.
So that's what they did in energy, and we're just getting started in gold. And Mako has a market cap of less than 200 million US. And like I said, it's operating cash flow might be north of 60 million over the next 12 months. Based on, again, depends on where the how much production they have and what the gold price is. And again, you're taking execution risk, right? Which, so when you buy gold stocks, you want to make the positions really tiny. I'm willing to put 40% in Fairfax, but only 10% in Strathcona because there's this commodity risk. I'm taking oil risk,
Hmm.
there, even though there's less execution risk because they're more diversified. So you can adjust your position sizes depending on the opportunity. And I think what's happened with a lot of investors is that they set up minimum investment requirements that they're not going to put any money in unless they can put 5% in. And I think when you set those kind of arbitrary levels, and I know why a lot of institutions do it because they have to do so much work in order to justify putting something into the portfolio that they need to put a minimum amount of size on it. And as soon as you do that for some types of businesses where there is existential risk, in some cases where if you have a single mine risk, and Make only has one operating mine right now, but if in that mine, if there's a problem either geopolitically or from a technical basis,
Yeah, then it's over.
it could be over, right?
Yeah, you're
And we
toast.
saw something like that happen recently with Victoria
Franco
Gold.
Nevada.
Yeah, well, Franco Nevada,
Ah,
Cobre Panama got hit,
yeah.
but they were very diversified, right?
Yeah, yeah,
So,
yeah, yeah. You paid a
and
premium for the diversification. Yeah,
yeah, and First Quantum, it was such a big position for them that they had to go
yeah,
raise equity at a very low price.
yeah.
And so you want to, unfortunately, the risk of owning stuff that other people don't want to own is that the risk on execution becomes higher because your
Yes.
cost of capital is higher, and you have to raise capital at unfavorable prices in order to close the hole and potentially advance whatever you're trying to advance. And because of that, your sizing should reflect that, I think. And
Hmm.
I think that's an important lesson for people in terms of how you want to size things. Like, think about how much you could lose. And if it's 100%, then you want to keep the position what I call option sized,
Yeah.
and I find there's a lot of cognitive dissonance with people is where they'll gladly speculate on options, but they won't buy a gold stock. And it's just like, well, think about it as an option that
Hmm.
doesn't expire,
That's true. Oh,
and
that's
then
a good
and
way
then
to
and
put
then
it.
and then
Yeah.
maybe you can be like, okay, I put 0.5% into this, or I put a quarter of a percent into this, and you can say if I lose it all, it's fine, but it could go up 10x, And so in that case, I want to be exposed to those right tails. My left tail is stopped at zero, and so that's a way of thinking about probabilistic investing that I think a lot of investors who are more deterministic, again, using heuristics to set their probabilities, don't really think about.
That is such a good point. If you don't mind, I'd love to go back to Fairfax again for one
Yeah,
second.
let's do it.
They own a bunch of random stuff. That's another. We didn't talk about that much, right? But
Yeah.
I that's something that I like about them actually.
Mm-hmm.
We touched on the fact that they want to keep that optionality and they have no rules really, so they're open to doing whatever, right? And
Mm-hmm.
they finalized two acquisitions this quarter. One of
Mm-hmm.
them I love so much, I almost invested in it like a year ago or 2 years ago. Sleep Country Canada, right?
Right.
What
Yep.
are your thoughts on that and the other
Yeah.
one, Peak?
Yeah, peak achievement. So Sleep Country is interesting. My understanding, reading some of the press that was on it, and talking to other market participants, that there was private equity was circling Sleep Country, and the management team there knew they would have to take something to the board if there was an offer, but they didn't want to work for private equity. They preferred to work for Prem, to work for Fairfax, and much like Berkshire Hathaway has this lore of people coming to them to sell to them because they want the business to survive within Berkshire. It's a better place to be part of because they can just focus on running the business, and only capital allocation decisions are really, I think, discussed with Fairfax. And so ultimately they decided to do a deal with Fairfax instead. And the way Fairfax does deals is a little bit, I think, different than Berkshire. I think Berkshire kind of buys stuff and buys quality and never sells it, for the most part, for the private stuff. But I think with how Fairfax looks at it as partnering with management teams. And so I think they see it as we're partnering with this management team. When this management team wants to sell, whether that happens in 7 years or 10 years or whenever it may be, Fairfax will also sell with them.
Yeah.
And when you think about the returns on this investment, one of the ways their hurdle rate, I should say, their hurdle rate for investments is 15% for equity investments. And so I think we can be fairly certain that that's what they think they're going to make here as well, at least 15%. And one of the ways they did that is, I don't know if you read the disclosure, but they borrowed extra money at
Yes, the
Sleep Country,
non-recourse. Yeah, the
right?
200 million or something, right?
So a little more than that, I think. Yeah,
Yeah.
and they
Yes.
levered up a little bit more at the Sleep Country level. And again, there's no when you're public, there's more risk about having that leverage out there because if you have to go raise capital, you have to raise equity capital. You're going to take a big hit.
Yes.
But when you have Fairfax as your partner, if you really do need capital for some reason, Fairfax can just
They
make an
can get it.
investment.
Yes.
So
I saw that. Yeah. They're
yeah,
so smart.
yeah, and they did the same thing with Recipe, and so that allows them to meet their hurdle rate. And when you think about what's really, I think, is missed by people, and we talked about this a little bit when we talk about that 3-to-1 investments to equity ratio. If you have something like Sleep Country that over, let's say, a 10-year period earns a 15% return, it's contributing effectively to ROE at 45%, right?
Right.
And so because you're getting 3-to-1 leverage, and so that really pulls up your total ROE from that 15% level. It starts pulling it higher. Now, with a private investment like Sleep Country, or even with something that is equity accounted for, like Stelco,
They're selling.
which that deal
Like,
closed
yeah,
on Friday. A lot of their gains are going to come at the end, right?
when
Because
they
again,
sell. Yeah.
when they sell, because the way these things are accounted for, they will take their share of earnings into the balance sheet. There's a lot of depreciation at Sleep Country of intangibles, so the cash flow is higher, but it's not going to show up in the earnings.
Hmm.
And so the returns are going to come at the tail end potentially, but you'll still earn a very nice earnings yield up front, maybe like 7-8% earnings yield, which again contributes at like a 24% into your ROE. So you're still going to
Right.
help your ROE in the short term, but then you'll book this big gain at the end, like they're doing with Stelco. And Peak Achievement, I think, is very similar. They had a partner in Sagard, which is part of Power Corp. And Sagard wanted to sell, and management seemingly didn't want to sell, and so Fairfax bought out Sagard instead of selling their investment as well, and they stuck with management. And so I think when management's ready to sell, which I assume will happen at some point over the next 5 to 10 years, then Fairfax will take its chips off the table too and book a big gain. Now they will book a small gain, I think in Q4, because they took control of that transaction. They will mark up
Oh, yes. It'll
part of their
change the.
position,
Yeah.
so there'll be a gain in Q4 on that. And so yeah, so I think some people are like, it's not a great business like equipment, but it's such a consolidated business. They're the largest player in hockey equipment, and so if there's presumably they can generate decent margins and decent cash flow, and again, maybe add to the leverage like they did with Sleep Country and pull more equity out,
Hmm.
um, and then use that capital elsewhere and earn higher returns on invested capital at peak achievement. So yeah, and these things are part of that $600 per share of equity investments that where analysts aren't expecting any returns. So and they're going to make money, right? Like I think Sleep Country
Sleep
is going
Country
to
is
contribute,
great.
yeah, over
It's
the
a
next,
great performer. It's
yeah,
been an awesome business. And sorry to cut, but I'm
no,
passionate
no,
about Sleep Country. I own one of
yeah,
their product. Like I have a weighted blanket. Yo,
right.
we love that weighted blanket. Like it's really good. They're awesome. And they've been amazing grower of earnings and free cash flows just over the last few years.
Yeah,
So
and they're really good at protecting their market, right?
yeah.
They bought Endy, they bought the rights to Casper in Canada.
Mm-hmm.
They bought the weighted blanket company Hush, I think it was.
Yes, Hush. Yeah.
So they've done these deals to protect their market share in Canada. And it's and the reason why the stock got so cheap is because there was a big boost during COVID of people
Yep.
spending on the home, and upgrading all of their beds and everything basically in their homes, and that really helped boost earnings at Sleep Country, and then earnings went flat. Revenues flattened out and they weren't growing anymore. And once again, the quants, when they see growth slow, they sell, and so that creates an opportunity where if I wish I had been paying attention, like I think it seems like you were, about oh, this is like a quality company that's now trading way
Mm-hmm.
too cheap. Now I will say, a lot of investors who when the deal happened, value guys, again, because they're value guys, they look at it as, it's only a 7% earnings yield. They should have bought stock back instead. Well, it's a seven if it's a 7% earnings yield, then it's contributing at 21% ROE. So it is still a good buy to do that. And you only get to buy the companies like this when the management's ready to sell to you and they want to partner with you. And so
That's
you have
true.
to take the opportunity when it comes. Otherwise, the next guy might not come to you. And so it helps build their reputation as well. And there's lots, and instead of passing on Sleep Country to buy back stock, all they did is slow down their premium growth in the insurance business, and that spins off so much extra capital that they've been
That's
using
true.
that to buy back stock. So it's not like they weren't buying back stock because they did that deal. And the money from Stelco is also coming in, right? That deal closed, so they'll be collecting on that as
Hmm.
well.
And
So,
let's not forget, they bought back a lot of stock this year anyway. Like that.
oh yeah,
Yeah.
yeah,
It's not like they did no buybacks.
yeah,
They did,
yeah,
like,
yeah,
they went to,
yeah.
overkill on the buybacks, which is
And
great.
why do they do that? Well, they also know it's going to go in the 60, I think, right?
Mm,
So
yeah.
they're not operating in a vacuum, and so I think they're very market savvy, and I think they recognize that, well, this index ad is going to happen sooner or later. Let's take advantage, and buy back as much stock as you can if they keep selling it to us at this ridiculously low price. And you know what, the effect of these buybacks, what I don't think people really appreciate, is that it really boosts forward ROE, right? Because you're buying your stock back cheaper. They're actually reducing their book value growth, but they're buying stock above book value. So book value comes down, but the earnings power stays the same, or is going up. So your forward ROE is actually increasing, and that's how
Mm,
you get multiple expansion, right? So when people start to appreciate that it's sustainable, then it'll help confirm the multiple expansion and create more reluctant sellers. Versus now we've had over the past 5 years, 7 million shares sold effectively if you include the TRS. Those shares had to be bought by the counterparties, so effectively they were sold. Those 7 million shares are taken out of weak hands, right? And now you're in a position, well, all right, how many weak hands are left? What price are people
true.
willing to let go of their shares? And you have a moment with non-discretionary buying of the index buying, where it's value insensitive, to really determine, hey, what's the real clearing price now? And not only is it someone who buys 4% of your shares, leading up to it, December 20th is when it would be effective. December 6th, we'll find out if it's going to happen or not. Not only do they buy 4% of the shares, they're also a buyer every week, every month, as people are adding to their retirement savings and buying
That's
ETFs.
true. Oh shoot.
So
Yeah, I didn't think of
you have a
that.
new buyer
Yeah.
that's always buying,
Yeah.
and they're already in the composite, which is already a buyer that's always buying. And on top of that, Fairfax has an under market dividend yield. And so all of their peers that have, especially in the financials, that have much bigger dividends, including Intact, well, those dividends buy Fairfax too, right? So you're
That's
you're
true.
you're getting you're getting this
Yeah.
this 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 buying, that is pretty significant and ongoing. And so that's how you can get the multiple expansion. That's why I kind of plead with people, hey, like, really think about value before you sell, and really think about, how much growth you're going to get. It's just like, buying Google or Amazon or any of these companies. I was smart enough to buy them, but I sold them way too fast because I wasn't focused on the right tail enough. And I'm trying to
Yeah.
correct that with Fairfax. And I'm thinking, well, as long as it keeps growing at double digits, there's no reason for the multiple to contract. Um,
Actually, I just got to jump in. You
yep.
mentioned Google and Amazon. That makes me think too. Fairfax has compounded book value 18% per
Mhm.
year CAGR since 1985, and I think stock was 16%. That puts it on par with these big
Mhm.
tech stock. Like I don't think people appreciate how well they have done. And I think it also, I read somewhere, it's like the top 2% of stocks in the world or something in terms of performance
Mhm. Mhm.
of that's insane from like an insurance business, right? That's
Well,
crazy.
it's
Over
it's it's
40
it's the
years.
magic. It's the magic of float, right? I mean, Berkshire Hathaway. One of the reasons why its performance was so good is because its stock picking was so good. And in the past,
Hmm.
Fairfax was a very good stock picker, and it kind of ran into problems in around just soon after the great financial crisis because they decided to put a bunch of hedges on, right? And that's one of the
Hmm.
major reasons why people don't own the stock is because
Yes.
they felt so burned by the hedges that were put on. Now, contemporaneously at the time, people loved it. They loved the hedges. The stock traded at a higher multiple then than it does now because people were like, "Ah, these hedges are the best thing," and you would see
Right.
it in the price action. You would see whenever the banks would sell off because people were worried about negative interest rates. They would buy Fairfax. They would switch. Financial active
Hmm.
managers would switch from banks into Fairfax to hide. And Fairfax was also the place to hide in 2008 and 2007 because they had bought all the hedges or they had bought all
And
the
that was
CDS.
successful. Yeah, yeah,
A very
yeah. And
successful
that worked
transaction.
very
Yeah.
well. Yeah,
So
yeah.
everyone,
Yeah, for
yeah.
people listening, if you read that book, they talk about how Fairfax was one of very few insurance businesses that did
Mhm.
very well in 2007, 2008 because they kind of saw it coming as far back as like 2005.
Right.
So,
And so
yeah.
they had this glow about them that they were really good at these macro hedges. And so people bought in when they put these hedges on. Now, if
Hmm.
you're an insurance company and you're forced to with your float to buy treasuries and there's a risk that interest rates are going to go negative, that's kind of a scary situation to be in.
That's true. Yeah,
So
that's so
that's why
true.
they bet all these deflation hedges and they bet on the market going down because it didn't make sense that you would have this world where we have negative rates and there's not the chaos in the economy. So I think they were it was the wrong move ultimately, but I think it came from a place of, hey, we don't want to blow up our business. Like we
Yep.
built something to last here and we don't want to take the risk. And on top of that, interest rates went to zero for a long period of time, and that really hurt returns. And so I think what's happened with people is that they're the most recent experience, like in the last decade, until up until the last 4 years, they were kind of like this thing, they make bad decisions. The returns aren't very good because they don't really understand the business model. They didn't really understand that a lot of the ROE comes from interest rates. And so when they weren't getting the earnings growth or the earnings they were expecting, they just sold.
Hmm.
And so that's why I think we ended up in the situation that we're in. And again, Fairfax has played it beautifully. Prem often talks about Henry Singleton. I don't know if you've ever
Hmm.
studied
Yep.
Henry Singleton, but he's famous for how he issued equity when the stock was overvalued and bought back equity when the stock was undervalued.
Yep.
And Prem is doing the exact same thing. He's playing exactly the same playbook, and I think they're happy to do it. And if the stock ever does get back up to 3 times book value or 2.5 times book value,
They will
maybe
issue
they'll
shares.
maybe they'll issue shares to buy something. Like Berkshire did to buy Burlington Northern. Maybe Fairfax will buy
True.
something like that. Something, it's going to be a lot bigger in 10 years. Maybe they'll buy another insurance company that has kind of fallen on the wayside. And so there's opportunities to use the equity once it goes up, and that grows your book value even faster, right? Which is one of the reasons.
Right.
I mean, one of the reasons why the book value growth has been as strong as it's been is because they issued equity when it was very expensive and they bought it back when it was cheaper, right? So these
Yeah.
things these things really help your book value growth, and they're a lot of people dismiss them, but they are tools in the toolkit, and they take advantage of every tool in the toolkit.
Yeah, another thing, just not related, but I just think of it of Prem's wanting to, build a business for the long term is again from that book is and that's like in the first page or two, right? But he talks about he never wants to do a stock split, which I really like. That's another Berkshire-esque type of thing, right? So the stock,
Mm-hmm.
it's like in Canadian, it's like 1800 now, right? I'm just thinking of days like what, if we get to 10,000 or something like that. How cool is that, right?
It's very cool. I think it's very possible the next 10 years for sure that we that
Yeah,
we get there. So
that would be
now
awesome.
it'll be interesting if anyone else creates a product to buy Fairfax cheaper by then, and that he's forced to announce a
Right.
B class like Berkshire was.
Oh God, yeah.
So and that would be huge if that happened because if you do have a very liquid B class share, then that that would have options attached to it.
That's true.
And the minute you introduce
Oh yeah.
options, the market participants have to buy even more inventory in order to participate in the option
Hmm.
market. So all these brokers and all these market participants will now be buying stock, and so you just create more demand for the shares. So it's another reason why the shares trade cheaply. Well, there are no options, right? So it's
Yeah.
another less reason for people to own it, less demand, and stock prices ultimately are just supply and demand, right? So that's why I focus so much on the flows, because I want to understand why people are selling something that's cheap, or buying
Yes.
something that's. And so you really have to appreciate the flows, I think, and that's where my experience, having been, in research, on a sales desk, on a trading desk, and still having all these contacts in the industry to ask them, you know, why things are happening the way they're happening,
Yes.
and
It gives
and
it
and being able
extra.
to synthesize that, I
Hmm.
think is really the edge I think I bring to the table. But I'm still wrong, 4 out of 10 times or 3 out of 10 times. I just this one, I just don't see the holes. I can't see where the holes are now. Famous last words, right? Something will come up that I didn't expect, maybe, but that's why you stay diversified, and
With
you take advantage of
42%.
opportunities. Yeah, I mean,
No, I love it.
diversified enough.
Yeah.
Well, I mean, one of the things is like, they're buyers of their stock. Premise said, I think he said it at an AGM a couple of years ago, that 1.2 times book is a totally reasonable price to pay, and
Hmm.
my understanding is he looks at that as adjusted book. So he takes the book value as the fair value over carrying value, and then takes the multiple. So we're still trading at kind of the range where they're still buyers of stock.
Yes, right.
And over the next few days, we'll find out how much they bought in October, if anything. But again, they've bought so much already, and I think, again, one of the reasons why is because they know it's going in the 60, and because shares are share prices are based on supply and demand. That demand has a good chance of increasing the multiple. They may not get another chance to buy them this cheap, and so I feel like that makes the margin of safety even higher, because how much can my
Yeah,
multiple contract if I have a buyer who's making $4 billion a year,
that's true. Yeah.
and can return, based on the math, if they grow premiums at 5% a year, they can return 75% of earnings to shareholders, and the dividend's relatively small, so it
True.
comes through share buybacks. Um, Once the stock gets too expensive, they have other sources, other things they could do with the stock. They could buy in the minority interests on the insurance subsidiaries, which they sold to help finance the deals initially, to sort of so they weren't taking as much risk when they did these deals. And there's minority interest outstanding in Allied World, in Brit, and in Odyssey Re, which we talked about earlier.
Hmm.
So there's places for them to put that capital where they have a very high return on it, which will increase earnings even more. Like, I think at the end of 2023, that math was, if they bought in those minority interests, it would boost earnings by $25 a share.
Oh,
So
wow.
it's like
That's
these
a
are
lot. Yeah.
meaningful. These are meaningful numbers, and why when you look at the analyst estimates, you go like, why are you guys, why are they so low? It's, well, there's no reason to be aggressive when a stock is very cheap, right? And
Hmm.
and also the sources of income are so volatile. They prefer, as an analyst, I know how they're incentivized. I know it's not good on them if their earnings estimates get missed.
Yes,
It's
right.
good if they
No,
get
that makes
beaten,
sense.
So
Yeah.
they want to be accurate, but they don't want earnings to come in below where they forecast, because it makes them look bad on their own evaluations. And
Yeah.
so you have this a little more conservatism, I think, from the analysts for that reason. But again, if you actually do the math as to what some of the big components of the equity portfolio contribute, it's hard not to get to a 15% ROE. And if you can earn 15% a year, you're going to be very rich over a long period of time.
Yeah. I think you've made the best case for Fairfax that's publicly available on any podcast or any YouTube. I'm saying this with all, I'm trying to stay humble here, but really, like, that I'm
Thank
just
you.
replaying this whole conversation in my head, and I'm gonna replay it when I, go through it and, like, do my little edits and stuff. But like, this is, yeah, I mean, it's I don't see how anyone who listens to this doesn't at least consider starting a position. But again, no financial advice, but doesn't consider, thinking like, oh my God, this is an opportunity right here, right?
Right, right.
Um,
Yeah, I
my
mean, I think,
God,
I think, I
yeah.
think, it's funny because I've had the opportunity to pitch the stock to so many people, and I would say the hit rate is very, very low at people who are actually interested in buying. And
Really?
yeah, and I think it
It's
comes
because
down
they are
to
Costco people, right? That
yeah,
type of,
they're
yeah,
quality investors,
yeah.
and they look at insurance as a black box often. And when I tell people when you're analyzing an insurance company, look at the history, right? Like look at over time how many what their record is of reserve releases. And over time, Fairfax has been very consistent in having reserve releases because they're very conservative on reserving, and they're conservative on reserving not just because it's prudent to be conservative. It's also the more you reserve, the less tax you pay upfront, right? So
Oh,
you
yeah.
increase your compounding too. So there's a financial reason to be aggressive on reserving. You might also keep your stock price cheaper, which helps you buy it back. So
Yes.
there's other reasons to do it, and they're not interested in being promotional per se. You know, but if you listen to Prem, he's very clear that the stock is cheap, and that the
That's
and,
true.
his common refrain is the best is yet to come, and I think that's absolutely
He's
true in this
correct.
case. Even though we've had 4 amazing years in the past 4 years, I think the best is yet to come because the multiple expansion can continue and the growth can continue.
Yeah.
So I
You know
don't
what?
yeah.
What you're saying about insurance being a black box, I think that again, that's part of why people don't buy maybe is that you have to do a lot of work to understand
Mm,
what's going on in this company. And again, I always bring stuff back to Brookfield, but it's a very Brookfield-esque in that way. Like I
mm,
remember when I started, but I had a lot of people say, "Oh, you don't like no one understands what Brookfield is and what's inside. They own 10 million companies, they have all these funds. It's hard to, you know what I mean?" And
mm-hmm, mm-hmm.
but it's also the fact that when you do that work to understand, when you actually see what's going on, that's where you build an amazing conviction because you're like, I can see all those pieces that are all over the place, but I see them fit together, and it's such a great opportunity. Do you know what I mean?
Right,
It feels
absolutely.
like
I
that.
agree. I agree. I agree 100%. I mean, I think also, if you do have this discomfort, and you do feel like even there's no amount of work you could do to get comfortable with the risk, then you size, much smaller, right?
Yes.
And
Yeah.
so, if it's only a 1% position or a 2% position or three, whatever it may be, in this case, you're buying something at like, 7, 8 times earnings. Maybe you can afford to make it a bit bigger where the earnings are more likely to grow than shrink.
Yeah.
Um, but even if that you're like just in case something blows up in insurance or there's four cat 5 hurricanes hit Miami in the same year and there's just a tremendous amount of write offs or hit New York City or something like that. I mean, um, you know, it's the company I think is built to survive those types of hits.
Yes.
And in fact, it's for the first time in their history, I think, if there were a really bad situation in terms of cat losses, where the company still wouldn't lose money overall if that were to happen, and if it was like that's like a 1 in 1,000 event, they wouldn't lose money, but like a 1 in 250 event, they would still likely make money on the underwriting, so
Mm-hmm. Yeah.
so they're positioned better than they ever have been before. And I think that's worth a premium
Yes.
as opposed to a discount. And I think we'll get it.
Agreed.
I think we'll get it.
And they did all that again while being nice people, like Prem and the coach. I know we spoke about this already, but like
Yeah,
for
absolutely.
people who research him and his team and stuff, I've never seen that before. Oh, no, you know what? I'm young, right? I'm 27 years old. Well, it depends on who you talk to, but I'm saying I'm young because I do a lot of stuff with like university students, like mentoring and stuff like that, right? With the people still in school. But I oftentimes I talk to them and I'm like, oh, I'm jaded by the corporate life. You know what I mean? And then I see if the Fairfax people, and I'm like, wow, they're treating people well. This is interesting,
Yeah,
right? So
yeah. I mean,
that's
one of the
special.
great stats that Prem puts in his letter this past year was that an employee earning $40,000 a year
Yeah, I saw
starting
that.
in 1985, if
Yes.
they had participated fully in the shareholder purchase plan, the employee share purchase plan, they would be. I think that position. And now it's probably worth
Like
like
three
5 million, but I think it was
million,
like 4 million
5 million.
at the
Yeah,
time. Yeah, so it's like
crazy number.
they've it's just a crazy amount of wealth generation for the employees as well.
And that's why
And
they
even
stay. Actually, we didn't talk about that, but the
yeah,
insurance businesses, all the presidents, So in his
Hmm.
letter, right, he shows the tenure of everyone, and
Hmm.
they're there like 28 years, 35 years, 38 years, and they're like, what? It's
Yeah,
crazy.
they get to focus on insurance, like that the business and the float is being managed by the parent, so they don't have to worry about that aspect of it. They can just focus on what they're good at. And like you said, there's really long tenure, and they generally only promote from within. And that's how you maintain the culture,
Yeah.
So, and so a lot of their competitors will be bringing in new teams, hiring new teams from other insurance companies, and you don't see those press releases from Fairfax. They
Yeah.
tend to only hire from within.
This other thing too that I saw in a Prem video. That's a pretty recent one, maybe like 8 months ago or a year ago. And I was kind of shocked, but then I was also like, this totally makes it like this is exactly it. In terms of the culture, is he talked about COVID when it started, and apparently he said, I never tell my insurance CEOs what to do, right? Because they run the business and I'm just do the investment. But he said for the first time in years, I told them what to do, and I said, you're not allowed to fire a single person. I don't care if they are bad at their job or if they don't even show up to work or any of that stuff. COVID just started. You're not firing anyone, right? And he
Mhm.
says, I don't care if it hurts our profits, and it probably will, but I don't care. That really speaks a lot to someone's character, in my opinion. That's insane because I can tell the amount of companies that just fired all kinds of people and that still do now. I mean, so yeah,
Yeah, yeah.
crazy.
No, absolutely. I mean, it's the culture is phenomenal, and hopefully people will figure that out, and there'll be another reason why it deserves a premium. So,
Yeah,
all these things that what I call like social value. Fairfax
yep,
has, we've been going on for a long time, but like, this idea of like market value, comparing market value to intrinsic value is how we determine if a stock is undervalued or overvalued. But I think over the past 15 years, because of this, because quality has become so much more important, and because ESG has become very important, you've had this. I've added this term social value to help balance out the difference
mm-hmm,
between market value and intrinsic value. And in Fairfax's case, it's hugely negative because of controlling shareholder, relatively illiquid stock, like high dollar price for the stock is a problem
yep,
for a lot of
that's true.
people. In the insurance business, highly variable earnings. So you go through the list of all these reasons, but then you have other stuff where, wow, what a track record. What an amazing way they treat employees, and customers, and look at the diversification, and look at the built-in leverage so all of these things are really add to the reduce their negative social value effectively. And at some
Yes.
point, maybe we'll have positive social value at Fairfax, at that point, that's when it's going to be easier for people to sell. I think,
Yeah.
but
Well,
that's a long
I
way away. I think.
I've invested and now I will be patient and I very much look forward to the next few years just to see what happens with them. But yeah, any last words? Actually, so something I like to do with all the guests, I would love one piece of advice you can give to investor, like anyone who listens to this show. What would you have to say?
I guess my advice would be to try to think about things probabilistically, even if it doesn't come natural to you. Try to think about what could happen, both positive and negative. I think a lot of value investors only focus on what bad things can happen. So I think most people have that covered, but try to think about what what positive things could happen and how that will influence your investment. Because in many cases the right tails are extremely undervalued, for businesses where they're not traditional, widget type businesses, or for
Hmm.
fast growth businesses. The right tails can become very, very big very, very quickly. So I guess the advice would be think probabilistically and think about the right tails.
Perfect. Hey, I think this might be my longest episode ever. So thank you for that.
Awesome,
This is
no
great.
problem.
I can't wait.
My
Yo,
pleasure.
people are gonna love. I can tell you, and I'm not gonna cut this, so people who listen will hear me saying this again. But before recording this, you see me on Twitter. I've been hyping this up. I'm like, yeah, Fairfax episode coming soon. It's gonna be great. And then right before I hit record, like when we were starting, I was like, I really hope this is gonna be good. And I'm like, yeah, this is great. This is awesome. So
Good,
really,
good. I'm glad.
from
I'm glad it
the
went well.
bottom of my heart, I'm really honored that you came here to speak and with so much knowledge about everything about Fairfax and these other companies too, right? I really, really appreciate your time. And I think this has been great for me personally, like selfishly, but I think it's going to be great for our listeners as well. So thank you very, very much.
It's my pleasure. Thanks for inviting me, and always happy to come back if there's another stock you want to talk about. Let's plan for that whenever that happens.
Fantastic. Alrighty
Awesome.
then.
Thank
So
you.
I will put all your details in the description. So
Okay.
for everyone, make sure to follow him on Twitter. Look at the description. Everything will be there. And yeah, thank you for tuning into the Newcomer Investor channel. I look forward to connecting